Yo, what's going on, guys? Froggystyles here. I'm waiting to see who wants to jump in. This is going to be some option talks kind of stuff. So I figured a lot of people probably won't want to join in just because they don't know a lot about options. Um, plus, I wanted to go over a couple of the videos too, just because it's covering like Trey trades and Astro and their theory. One calls it like squeeze theory or whatever. I just call it option theory because it's both of them. But give me a second. Let me fire up this space call here, and we'll get things rolling here. Actually, let me reset this real quick. What's going on, mediocre trader?
What's up, buddy?
Now, what I wanted to do in this segment was cover, I think there's only 5 videos of Astro and Trey, and the goal is not to criticize these guys for what they think. So we don't know what's right and what's not. So we're going to try to get into it and see if we can figure it out. Trey and Astro did have invites. I don't know if they're going to show up or not. It'd be very easy for them to come in and explain themselves, but we have to take from what we get from the videos. So we'll see where it goes from there. So am I right? There's 3 videos from Trey, 2 from Astro that pertain to the option squeeze theory.
I'm pretty sure there's 3. Yeah, he did 2. Trey did 2, and Astro has 2. But I think Trey kind of has a third one, but it's a little different, I think.
Okay. Yeah, I know the third one was. I didn't get to see the third one yet. It's I think he called it the final video. Isn't that the third one?
Yeah. I don't know. I watched it, but I don't remember it, to be honest with you. Let me go take a quick look. Hang on.
Let me make sure I got the right videos here. They're all labeled the same. You're going to have to watch this one. All right, so Casey Shaw, come in. Give me a second. Let me get him an invite sent out here.
Yes, please.
I was hoping he would shoot. Let me see if I could send him this link.
Yeah, it gives me.
I hope it ain't too late because we did just fire up. Let's see if that works. So I wanted to watch the video. I know they're freaking forever long. That's the problem. We got a 30-minute. We got a 30-minute, 13-minute. We got a 21-minute, and then we got a 19-minute. I really don't want to watch all 3 of those, but if we can get at least the points that they're trying to touch on and see if there's anything that makes sense. I trade options. I know Mediocre trades options. I'm pretty sure Casey Shaw trades options. So let me see here. Give me a second. Now, Miss Harris, we're probably not going to be taking any questions. I just got Space Call open, so people can come in and still listen. So we might take questions at the end, or like throughout the segment, we'll open the floor up for questioning. But all right, let me see. Let's wait for Casey Shaw to get up in here because I want to get as many brains in here as possible because options really isn't easy, and like the theory that they're trying to pitch is a couple different things, and I know there's going to be tough because you got like a moving bus full of people moving in one direction, and they're expecting us to do something other than buy hold, which has been working. Welcome, Casey Shaw.
Howdy, can you hear me?
Yep.
Yes, sir.
Is my video? My video doesn't seem to be working. Hold on, there we go.
There it is. So I thought that Astro's last video was more clear than the other ones I had thought. But in the last part of it is what I was curious about. The data that they're using is on the implied volatility.
Yeah. Yeah, they were working off the implied volatility. That's what I seen, and they were saying I can't remember what the ratio was. If it's lower on puts, that the price will go down. But it doesn't exactly work the way that they were looking at. That it was like an indicator of which direction it was going to go. But now the goal is not to criticize these guys. The goal is to try to figure out what they're talking about and see if we can translate it to something that makes sense. Because Casey, do you trade options?
I do, but not on a regular basis. It's very rare, and I have to say that I am by no means an expert on options, so I will never claim that.
Well, you
Yeah, I'm
understand
not
the
either.
common sense factor of what they do.
I do.
So that's what's important is we need the education. Like I did send an invite out to both of them. I'm not sure if they'll actually show up or not. I mean, it's very simple for them to come in and explain what they were talking about and try to educate people by putting a video out and just hoping people just run wild and start playing options is kind of crazy. That's why I figured it'd be nicer to come in, try to educate on stuff and try to see if we can make heads or tails of what they were talking about.
Well, they kind of turned around and didn't necessarily say that everybody should be playing options. They kind of said towards the end that if you know how to play options, that it shouldn't be that you play puts or calls is what they were getting at.
Yeah. Well, let me start up this first video of trade trades. Hopefully I got the right one here. Oh, sorry, I got this wrong file here. My bad.
I love it.
No, I'm just playing around. But all right, so let's fire this one up, and we'll take breaks throughout here when there's talking points. If you guys see something you want to chat about that you think is a talking point, just hit me up in the restream here, and then I'll stop it and we can discuss that point, because I'm going to try to stop at certain segments that sounds like they're separate things that he's talking about that might have something to do with, because we're all looking for the same thing. We want the squeeze. And if there's something to be gained from this, maybe they found something that we don't understand.
Exactly.
If we can dig deep in there and find it and there's something there, I'm all for it. So I want the squeeze to come. So let's dig in and see if we can figure it out. Let's start with the first one here.
All right. This video is going to have a lot of things stated in it that maybe people don't agree with. It's going to have things stated in it that are probably going to be controversial. Maybe you'll have a gut reaction of frustration towards me, but I want to make it perfectly clear that this is my real analysis, thoughts, reaction to what I believe to be the case based on research. I want to give credit where credit's due. This is coming from Astro. Astro has thrown together a weapon of a video. It's called the Short Seller's Secret Weapon, and it has brought me to this conclusion. I've sat and I've pondered this for a good couple hours. I've thought really in depth about what this means in the grand scheme of things. And I think what you are witnessing in real time right now, you ever seen the movie The Big Short? You remember the credit default swaps, the housing crisis, the credit crisis, all that sort of stuff happening, right? I think you backtrack to 2020 when stimulus checks went out, a lot of new money came into the stock market via retail. I think you watched a transformation get thrown into the market. And I'm going to give you an analogy later in terms of what this means, but I think this can lead into what I would call the big squeeze theory. You hear the big short? I think this would be the big squeeze. You could call it the big long, I guess, but the big squeeze, that sounds a little cooler. We've got a lot to discuss, but the premise behind my theory today is going to be behind options and market makers. These two things, market makers being the villain, options being the tool they use to manipulate stocks via themselves. Mind it, it's not you, right? Retail, I've said this before, I'll say it again. I think retail controls about 10% of stock price movement on AMC, GameStop, and the majority of other meme stocks. I mean, these are the two that I talked about, but I think this happens across the board. I'm going to show you my case behind why. But 90% of this, 90%, Max Payne, options expiring worthless. 90% of this is because of market makers and how they decide to move stocks via their own options. Let's dive into this.
Now, I'm going to stop right there. The Max Payne thing used to be just a conspiracy theory, and now from our analysis, oh, you think it's too loud?
Yeah, I didn't want to say it out loud. I think that's why it's echoing.
Yeah,
Okay.
it's got a really bad echo. I thought it was just me, so I wasn't saying anything.
So, obviously, the max pain. What's your guys' thought? Fact or fiction? Do you think that there's actually max pain and it makes a difference?
Yes.
Yes.
Yeah, I agree too. I think max pain is 100% a real thing, and technically that is market manipulation. But this whole market has been stupid for at least a year. Like everything that can go wrong has seemed to go wrong. So let's see what Trey's going to do with that. I'm going to try to turn my sound down a little bit more.
Video. This one's not going to quite be 30 minutes long, but as you can see by the title, this is part 2. I said yesterday that I was going to continue on with the big squeeze theory, and I wanted to leave people some time to digest the information that I discussed. And today I want to dive into not necessarily the market maker mechanics and why I believe this to be the case, but more so what I think this situation would look like. As always, I'm not a financial advisor. This is not a financial advice. Please take the great sell. Do what you got to do, right? I'm not here to tell you to buy. I'm not here to tell you to sell. You're in charge of your own finance.
Oh, I flicked the wrong one on. My bad. I was like, why isn't it moving? They both got whiteboards.
Credit where credit's due. Let me start off with Astro's video, right? Astro's video has far more detail behind everything that I'm going to be talking about here today. So if you'd like to know the nitty-gritty, the details behind everything I'm discussing, this is your spot. I want to give it the most simplistic approach possible so that it's digestible, because I think these are some really wild concepts that can be slimmed down even further. We can trim off some more fat to make this approachable for anybody, right? I want to start off here with market makers and options, because if we want to believe the big squeeze theory and the fact that all stocks that have options, including names like AMC, GameStop, CEI8, or BBIG Prog, SPRT, DWAC, Fun, all these stocks have been manipulated by market makers, we have to first understand how and why that would be possible. The assumption of my theory runs off the fact that maybe retail controls, if we're lucky, 10 to 15% of stock price movement. What's the reasoning behind that? If you were looking at institutional ownership on a wide variety of different stocks, but just as an example, let's go to AMC. We know that as of the most recent information tied down by legally obligated statement of Adam Aaron, stating that 90% of...
All right, I'm going to disconnect that real quick. I don't know what happened there. Could have been because I hit the pause button. That'd be kind of weird.
Yeah, the other video wasn't echoing, but then that one started to, so I don't know. It was kind of weird.
Yeah, there's something goofy. Let me know if this is doing it.
Of the float, excluding ETFs, excluding institutional ownership, excluding any sort of short position, is owned by retail investors. If we were to take that information, look at how many current shares are shorted into the market, which is 108 million, we're going to come over here and look at AMC institutional ownership as it states right now, as it sits right now. You're going to notice that about a third of this, as stated in Astro's video, is owned by institutions. It comes out to about 36%, 187 million shares. A lot of these were bought back in June. He also states this in his video. To expand this further, however, if we know that 36% is owned by institutions, and this is 1,000,000% relying on the fact that this data is up to date and is not behind. We know that 90% is owned by retail. We know that roughly 108 million shares are shorted. This could also overlap with the institutionally owned shares. It's very possible they could be lending these out. But this doesn't even include the ETFs, right? ETFs also own a majority of the shares. It is safe to assume then that if 36 is owned by institutions and 90%, let's just take this, right?
Oh, so we got the echo again. I don't know what's causing it. Casey, or Mediocre Trader, is it still there?
Yeah, even when you're talking now, it came back a little bit. Is it?
I
I'm
don't
not sure
understand
why.
it.
Yeah, me neither.
Sounds like you've got two different feeds going.
Yeah,
It's
exactly.
feedback looping or something.
I don't know where it's coming from.
Are you playing something to a space call, and then the space call sound is coming back to you? Because
Yeah, but I've done this before, and yeah, it's like 4 devices going. Not sure.
Can you mute your mic on the space call? Oh, no, because you're casting it to the space call.
We might have to cancel the space call, guys. If you guys can head over to the live stream, because this happened before. It was with the space call. So head over to the Froggystyles live stream, and I'm going to fire it back up over there. So I'll see you guys later. I'm going to cut this one out. The space call, I mean. All right, so let me try that.
That these people are likely not what are moving the stock back and forth. They're not trading. Institutions like this, they typically don't trade. They don't trade large blocks of shares in the form of commons. Commons is what you can think of as the actual physical stock, right? What these guys will do, if they want to trade, is utilize options. But the institutions aren't even really the bad guys, right? We look back on Melvin Capital back during the GameStop debacle when the congressional hearing happened. Melvin Capital almost went under. But to me, they're a scapegoat. These guys weren't the real villains. Do the real villains actually ever get caught until the end of the story? No. If you were to watch the story take place in real time, you know, Melvin is sort of what I would say to be a fall man. I mean, these guys were just fall mans. Were they doing bad stuff? I would imagine so. I don't even think that Robinhood's really the bad guy here. Yeah, it's easy to point the finger at them because they did fuck up. They fucked up bad. But at the end of the day, they had a collateral issue. And was it really a collateral issue that they were able to manage, or was it a plate that was kind of thrown on them by the bigger villain, the market maker? This is all theory, but I'm going to back up some huge fact outside of this. This is my personal opinion on these guys. I don't even think these guys are the bad guys. Bad guys, if you buy into the fact that 36% of this stock is owned by institutions, 90% is owned by retail, ETFs take up a chunk, and you buy into the fact that, hey, in a low liquidity situation when there's not a lot of shares available to trade, and there's still trading taking place, it has to come from somewhere. I believe this comes from market makers. Let me tell you exactly why. I believe this comes from market makers via options for a very simple reason. Options are traded every single day, and they are a tool used to hedge against a core position or commons, right? If I was just, list off, and this is where I actually owe people an apology. A year ago, I would scream into the void. I would scream into the void and say short ladder attacks are the problem. Naked short selling is the problem. Maybe arbitrage is the problem. Maybe it's latency time. Maybe we look at all these different things. We look at the weakness of the mechanics behind the stock market. But to me, these are all just branches. They're not the core problem. Am I wrong in saying that? No, not only spit. But is it the core problem? They're branches. The core problem to me is options. Options are a legal tool in which market makers, by regulation, by the books, have ways to bypass what normal everyday plebs like you and I have to abide by, the normal rules. They're able to get by this by utilizing options or massive leverage. You can probably see where I'm going already by saying that I think this is a repeat of 2008. In 2008, they had a credit crisis. Now,
I just want to say, like, what he's talking about right there about options is pretty true. Like, if you have a stock that doesn't have options in it, right? And then they look at DWAC, for example. When they put the options chain in there, it dumped, right? But before that, it would go up. So some of what he's talking about is true, I would say.
No, that's exactly right.
Oh yeah, go ahead. Sorry, go ahead.
I was paying attention to that, where when everybody's forced to buy raw stock and that's the only thing available, it forces the price up. So when the options become available and you get to buy puts and calls, you divide all that buy order flow. I'm not saying in half, but it's a divide and conquer. So you got, let's say, like 25% drop out of the main play and they buy puts. Well, that's downward pressure. 25% buy calls, that's upward pressure, and they somehow cancel each other out, and it takes them off there. So what's remaining for buy pressure is the only thing that can drive up the stock. Now, technically, options has delta, and they're supposed to be hedging to push the stock price up too. But does anybody know if they're actually doing it? That's the question.
And I would also contend too is that I think this is in knowing that I stand against the idea that options being played by everybody is what we need to do to get this to happen, to start a MOAS. My contention here would be is that this is the exact proof as to why playing the options or being a part of the options game is what tends to make these stock prices not function the way that they're supposed to play, because people start putting money into the options and it forces positions to be made. And because of that, you end up seeing the markets hedge the way that they do, and it tends to kill upwards momentum in a stock play. So I mean, but we'll let's continue on and listen to what it is, and I'll talk about some of my points later. But I think that's a great example that he brings, that you guys are bringing up with DWAC, especially. It was moving up in price. Options were introduced. It went to crap. So
exactly.
I think that's a very important point to note that he's not touching on. So excuse my interjecting.
No,
we're
you're
good.
fine. That's what we want to do. We want to try to bring it to light. And yeah, he's right. He's touching on the right thing.
I personally believe it's a liquidity crisis. With that being said, I think if you were to look at the way that options are hedged, what you get to witness happen in real time, very simply put, is market makers executing Max Payne theory. For example, let's say that a stock is on a rampage and all of a sudden it starts consolidating, right? It starts consolidating and market makers want to push a stock price down. We're going to get into the reason why they choose to do that, looking at some data, looking at some facts. But let's just say for whatever reason, this XYZ stock with options being huge here, by the way, they want to push this down, right? Well, what are they going to do? First things first, I think they have a list of 3 different things, as Astro puts in great detail in his video. Number 1, they're going to sell covered calls. This is bearish. Why is it bearish? It's because they personally, a covered call is a bet that the stock price is going to go down. And if it stays beneath the designated stock price, for example, if right here is $10 and I have a covered call for let's just say $11, right? Or maybe $9. Say I have a covered call for $9 and the stock price at expiration date is at 7. I collect all that premium, right? It expired worthless. These guys who are long on that call, they don't get to collect. They don't make any money. Their contract expired worthless. So you collect the premium. Let's say the premium is $50. You made yourself $50. Congratulations, right? Well, how are they going to do that? First, they're starting off with covered calls. Bearish situation.
Can we stop right there for a second, Froggy?
It's a bearish signal. Secondly,
yep,
I have a little bit of contention with this point. He's calling it a bearish move, and if you go and you look up the definition of a covered call, it's actually neutral to bullish, and I'll tell you the reason why. The reason it's neutral is because the person who's making a covered call lose their shares. Bet that the price isn't going to necessarily reach the price that they're going to set, or the covered call that they're going to sell for. So they don't want to lose their shares. And if they don't want to lose shares, that means they're bullish, not bearish. You sell a covered call because you think the price won't reach a certain point, not because you think the price is going to go down. It's neutral to bullish, and if you go and you look it up on most any site, it'll tell you that it's neutral to bullish and not bearish. So he gets that wrong.
Well, the thing about covered calls, I sell a lot of them, and I know that when the price goes up, you want to sell the covered call as close to that point as possible. You're expecting it does not go up anymore, so you can collect all that premium. So in my terms, when I sell a covered call, I'm actually bearish. I expect it to go down or stay below that number, so I put a limit on where I think it's going to go.
You would be bearish if you expect.
I know.
You would be bearish if you expected to lose your shares, because you're making a bet that you're not going to lose your shares, and you're saying I'm not going to lose my shares. I don't think this is going to go above this point. That's neutral. It's not necessarily saying yes, it's neutral, but the bullish part behind that is you bet is so correct that you're not going to lose your shares over this bet, and so that's the portion of the bullishness that it is. So it's neutral bullish. It's not actually a bearish position.
But when I sell covered calls, if it goes down, I make money.
Yes, but that doesn't mean that you're bearish though. It just means that you don't believe the price is going to go above whatever you set for. For example, let me give you an example. We're sitting on AMC at 1824. If you were to sell a covered call, would you sell a covered call at $18 or $19 this week?
No,
it would depend on like what the chart looked like, but I would probably be a little further out for safety.
Yeah, you see what I'm saying? Exactly. That's the point that I'm trying to make is because you're bullish. You're bullish because you're not going to make that bet because it's kind of a bad bet. You're going to make the bet that I'm going to go with maybe $25, and therefore, you see what I'm saying? You don't just make it at 19, you make it at 25 because now you're bullish and you're saying, I don't think this price is going to get up to here. And I think I'm going to get to keep my shares. And that's what you want to do. So if you want to keep your shares, you have to be bullish. If you wanted to get rid of your shares, then you would be bearish.
Right, but I don't think you could sell a covered call at say $60 right now.
No, because nobody would take that bet.
Exactly.
Right.
So
But that doesn't.
that's my point. I'm not saying that it's bearish either, because I know it's a neutral position, but a person who is bearish on the stock would also use that position if they were holding. Well, they're not obviously they're not bearish if they're holding a position in the stock, right? But
Exactly.
I see where you're going with this. It's
Yeah.
hard to say.
you can't be bearish if you're saying I want to
you're
hold on
holding
to
the
my
position.
shares. Yeah, if you're holding your position, you are bullish, not bearish. And so he gets this entirely wrong right here when he says selling covered calls is bearish. He's completely wrong. He's just wrong, and that's not how it is. If you believe that your stock is worth something, you're going to hold your position, meaning you just don't believe that it's going to go above a certain point, which is the neutral portion of selling a covered call. Right. And so because you believe so much in your bet that you believe you're going to hold on to your shares, that makes you bullish. And you can look it up on Investopedia or any other site, and it'll tell you it's neutral to bullish.
No, you're right, because if you're bearish on the stock, you're not going to be holding a position in the stock, number one, right? And
Right.
instead of selling a covered call, you'd sell a put, or you'd buy a put. I mean, you wouldn't sell a put, you'd buy a put.
Right.
So, I mean, you're right in the terminology there, but in his defense, I see what he's trying to say. Like, you don't think it's going to continue up anymore either, right? So you think that's
Correct.
not going to pass this point, which is not necessarily bearish, it's neutral. But if I knew the stock was going to drop, I would sell covered calls, right? Because I know it's going to go down. That's the part that he's talking about is kind of bearish about it. And I kind of agree with that, because you're talking about safety, right? If you know it's going to drop down and you don't want to lose your position because you're actually bullish on the overall stock, you just want to collect that premium. You're gonna do that, make money.
Yeah.
Yeah. Now the terminology or the definition, like not definition, but what you're explaining is what it's supposed to signify. But as someone that sells premium, like, it might seem bullish, but I become bearish at that point on that cycle, hoping that it doesn't go any higher, so I can still make my spread, make that easy money, and I could just reinvest it.
Right, but hopium is not what we're talking about. We're talking about an actual bet that you're making. Your bet is that I don't think I'm going to give a strike price that I don't think it's going to go over, because I don't want to lose my shares. Right? You're not gonna make a bet based off of hopium. You're gonna make a bet based on the idea that price just won't make it over that point, which is the neutral side of it. But I understand what it is that you're saying. But I just wanted to clear that point up and just kind of, because when I first heard him saying this in the video, when I first heard, and I had to go look it up myself, because I was like, I thought that was a bullish position. So I went and looked it up, and sure enough, neutral bullish is what they call it. So, but anyways, go ahead. That's just, it was a contention that I had on my side when he was explaining things. I was like, okay.
Yeah, it is kind of confusing, because like, selling covered calls when your stock is going up and it might squeeze is kind of crazy, because you lose the top. And when it's going down and you're selling covered calls, you're accumulating on the way down. So that's the way I look at it. Now, based upon like terminology and stuff like that, that's the way I look at it. So I know it seems completely the opposite of what the way it's defined as, but when I invest, I don't look at it as being bullish. I look at it as a way to collect. And
I agree with you. I do the same.
If it
right,
looks like
you're just trying to make money. That makes total sense to me.
Yeah, because you still want it to go up, so your main investment grows. So we'll say that if you have raw stock and you're selling premium, you're hoping to collect all that premium so you can buy more raw stock. And they give you the money today, so you could buy raw stock. So if it goes up, you can still make a little extra gain in a compounded fashion. And then you hope that they don't go into money, so then you can just keep all that premium and never have to pay it back. Let's continue here.
They sell, they short, because get this, options market makers and market makers in general, their job is to hedge. they hedge positions, right? So if they decide they want to go and sell covered calls, which is bearish, they then are going to watch what kind of comes in and comes out of their own book system. Let's say that all of a sudden a huge covered call order comes in, they sell a bunch of calls, which is bearish in nature, and they have to hedge against that, which pushes stock price down, right? Pushes stock price down a little hair. They decide to sell short. They sell because all of a sudden you've got more calls previously. Maybe a $10 call decides it runs out the money. They get to unhedge that, right? They get to sell positions to the downside, right? They push the stock price down. Boom, comes down. Meets their desired price. Maybe it's $7. They've got their covered calls for $10, whatever. They get to collect that premium. And a market maker, if they're playing big money, they can make hundreds of thousands, millions of dollars. M's, big money. Which brings me into the final piece, short exempt volume. This is something you've seen me discuss in great detail as of late. I do have an algorithm that actually combs through the FINRA regulated and reported short exempt volume that comes in every single day. And the easiest way that I can explain to you what short exempt volume is a synthetic share. If you want to talk about naked short selling, this is it. This is the largest scale legal form, legal, by the way, legal. Short exempt volume is something that by the books, these guys can do without any repercussions, as this is basically a self-regulated entity. This is a self-regulated practice. They create synthetic shares. Now, what would be the reason? Well, let's just think about this on paper. If you're to sell covered calls and all of a sudden a whole bunch of different calls run out, from in the money to out the money, they have to go short, but there's a liquidity crunch. We have to come back to this, right? There's not shares circulating around. These guys, the majority are holding, plus or minus maybe 5 to 10% retail. The institutions are holding, toots are holding, plus or minus maybe 5 or 10%, right? Where are they going to get their shares? We see that the stock is trading on a day-to-day basis outside of major rips, maybe 30 million, 40 million, 50 million shares, whatever, right? If all the shares are tied up, where do they get their shares? That's where this piece comes in, right? They have to short, they have to hedge, but there's not any actual shares. There's a liquidity problem. They have to create them. Synthetic shares. Bam. The most recent and rampant and nasty version of this has been Mullen, but this has happened with AMC and GameStop. It's a very realistic thing. It has happened. It has happened. I think these are the three tools that market makers use to manipulate a stock. How do they choose to do this? How do they choose to push down or to push up? I'm going to get into this in a little bit, but first, I want to discuss the next piece on my agenda.
So what he's talking about there is the short exempt shares.
Yep, and
I
those
think
are.
He's 100% right there.
I do too. The other part to it is as well, and we track this on a daily basis on my live stream, is short share restriction. When that's tripped, when Reg Show is tripped, they legally have the ability to create, which he's going to go to in here in just a minute. And I actually support most of every single bit of DD that he talks about here. I support most of it. It's just that I think he's missing a few key points that he's just not going the extra distance on. But what he's going to talk about is how they legally are allowed to create liquidity in the market when short share restrictions is tripped and Reg Show is in place. Market makers are bound to have to create liquidity with short exempt volume, which is exactly what he's going to talk about here in just a second. And he's 100% right. I totally agree.
Yeah, the short exempt volume thing, I never even knew was a real thing until this play happened. I never even paid attention to what a market maker did. I just thought that, like, my order went in, hopped around somewhere, I got a share, and it was all legit. Then I started finding out, wait, there's a lot more to this mess than what we think. So I started looking into it, and that's when I found Darkpool stuff, short exempt volume. Do they ever get covered? That's the question. Do they ever cover those shares?
Yes, there are instances where they. Well, I wouldn't call it covering. I would call it more finding shares and I don't want to call it covering. It's locating of shares and actually having to deliver, because it's a failure to deliver, and that's what he's going to talk about here in just a second. When they do have these failure to delivers that occur, they just print synthetic shares to be able to cover those positions. By replacing shares that we have on the market with synthetics, and then using those shares to deliver with. So but then I want Trey to continue to talk here, because my stuff is coming in kind of later on, and I want him to kind of finish it what it is he's talking about. So
Yeah, the one thing I was wondering if they actually ever, because all those short exempt volume shares turn into almost an FTD, almost all of them. So at some point they have to be bought to be covered, but it doesn't look like they're doing that. It looks like they're just kind of sweeping them under the rug, and they're waiting for people to sell them so then they can use them to take them back off the market. You see what I'm saying? Because when they add those shares, that's how they go above the float.
Yeah, it's absolutely correct.
Which is the manipulation in and of itself. In order for them to decide the way that they want to manipulate a stock, right? Using options as a tool. If you're tracking so far, if you've bought into the theory that the majority of meme stocks are retail owned, institutions own a large chunk of these, and then from there, market makers handle the rest of the chicken, right? They take up the rest of the pie, and I personally believe that far greater than 10% of the actual volume, because there are short exempt shares and synthetic shares and phantom shares, whatever you want to call them, that circulate around on a day-to-day basis take place. They choose the direction based on something called historical volatility compared to current implied volatility. What is historical volatility? Let me just show you this. Check this out. There's a handy dandy website over here where you can look up the historical volatility of basically any stock. If I search up the historical volatility of AMC, for example, historical implied volatility, that'll make it a little bit easier. Historical implied volatility on AMC. I come over here to Market Chameleon. You're going to see the movement back and forth. There's even a better website where I won't have to pay for some dumb bullshit. Let me come through this. Historical implied volatility. No thanks. Check this out. You'll be able to see this. Historical volatility. What do you see here? 9%, 8.5%, 18%. I'm just going to come back to the other website. You're just going to have to look at this kind of blurred out. But you're going to see something which designates sort of the way that these stocks have moved in the past, right? You can see the historical volatility moving up and down, huge spikes. You'll notice that there's a big spike right around that June mark. You'll notice there is another spike up here as of just recently. And this is essentially just telling you, compared to previous implied volatility, where the current volatility stacks, right? So I'll just draw this out for you. As an example, if I wanted to draw this out and show you what historical volatility would look like. Historical volatility would be, if we know we had a huge pump in June, we had a huge pump in January, and we had just recently had a huge pump in March, right? What do you think the implied volatility is going to do? Implied volatility being a metric that basically analyzes the pricing of options and derivatives, you're going to notice that they spiked here. Historical implied volatility, spiked here, spiked here. What market makers are looking for in order to pick a direction is which side of the trade, calls or puts, is cheaper, right? Makes sense. You want to buy whatever's cheaper. If a call is cheaper, market makers are going to lean towards moving the stock that way. Puts are cheaper, they're going to lean on moving the stock that way, right? Right now, where we are, if I had to take a stab at it, is market makers can see that puts have a cheaper implied volatility compared to historical implied volatility, or HIV, and they're leaning towards that direction. So they want to compare historical volatility, historical implied volatility, to current volatility. Whichever side of the trade is cheaper, they move it. Right now, it'd be puts. Puts have moved down a little bit. You can see this as of today, right? Look at this. Volume's moving.
No, wait. He's talking about historic data versus current data.
Yeah, that's what I was trying to talk to you about earlier. Remember, I was brought up the implied volatility thing, and that's We'll get to Astro's video last, but Astro's last video kind of explains a little more. But that's what I'm curious about. Now I'd like to know what you guys think about it.
Well, I think I missed this part where he's talking about historic data versus current data, and they're taking and subtracting the difference between the two and like moving it in that direction. So that's kind of a head scratcher in itself. It would prove that they're playing off of a pattern, which would be historic, and if that's what he's saying. I do have a couple questions that popped up in here, so I wanted to address those real quick. Julie says, remember what Boss Blunt said last night, retail does not move things? That's where I'm confused. Retail with raw share buying is just a minor fraction of what's going on. The options with all the options and a lot, like the way that it's set up, options really do move things kind of a lot more. So that's why they say you got to have options in order to make that gamma squeeze kind of thing happen.
Casey, what do you think about that the historical implied volatility? Think it matters?
Well, I remember watching the video, and I mean, I really.
He's breaking up.
Yeah.
To be honest,
You're having trouble, Casey.
most of his DD is complete and thorough. Having connection problems.
Yeah. Oh, he just lost all of his connection.
Yeah.
Question here by Namac says, can't you just buy back in? Yeah, you could buy back in whenever they take your shares. Like, we'll say that the stock is trading at 18.50 and there's call contracts sold at 20 and it hits 20. Well, they give you $20 per share. That's what that means. So they actually close you out and basically force you to sell your shares to the other person for that price. It's a contract. That's what it is. So some people think that you lose everything. You don't. You might lose your shares, but you get $20 a share in cash. So it's based upon your strike price is what they give you.
Exactly.
Jay Boy says, when stop renting? Oh, man, that would be nice. Let me see if we got any other questions. I'm going to give Casey another second to get back in here.
Yeah, let him he probably has to restart his computer.
Yeah.
Let me check Discord, make sure he didn't jump in there.
Big Mix says the SEC has allowed market makers to abuse short exempt, but the actual regulations has restrictions on abuse. See, that's exactly what I think, too. I think the SEC is allowing the rules to be bent by the market maker for whatever reason. They could just be robbing from us and paying everybody. That could be part of the whole Citadel Connect thing. Something definitely is weird going on. The market's never been like this before.
Yeah, it's pretty corrupt. I believe it's pretty corrupt. I'll just say that. That's my opinion. You guys can make your own judgments on that.
Yeah. Well, I don't see him coming back in yet. He might be restarting. Yeah. I'll fire it up and then we'll see if he needs us to go back. We'll cover it. But if not, I think he knows exactly what's in the video.
He's in the Discord, but he's not in a voice room, so.
He says he's rebooting right now. I'm asking him to see if we can continue to play or not. Yeah, so far everything he's saying is pretty true. I want to know about the historic volume thing volatility on how that relates to where they move things, because that would be interesting.
Down for some godforsaken reason, coming off of a huge momentum breakout. As I mentioned many times, I don't think that retail is really moving the stock. I think that market makers are what move the stock back and forth, back and forth, back and forth every single day, right? If we're buying into that, and you look at sort of the way and the mechanics behind this, you're going to notice that this is the case. They pick whichever direction goes. Then we come back to our previous theory, which is this. If it was to the downside, they sell covered calls. They then hedge against that. And then if they don't have the liquidity, step 3 is optional. They have short exempt volume, right? Opposite direction would be the exact opposite thing. If they think that the stock price is a much better long position because of historical volatility compared to implied volatility, whatever, they're going to go sell puts. They're going to sell puts, which is bullish. Maybe it's a put for $95. As of just recently, that's something that we did see happen. You saw puts getting sold for $95. This is bullish. Stock price starts going up, right? Then they start buying. We do the exact opposite of what we just mentioned. Instead of selling or shorting, they go buy. What happens if they can't buy? What happens if there's no shares? You go to step 3. exempt volume. You create shares. You create the liquidity. Now, having explained to you this three-step process, is this starting to sound like anything? Is this starting to sound like a tinfoil hat theory? It might. It might sound like a tinfoil hat theory, except in Astro's video, as he shows you, go watch this, please. Unusual Whales proves to you it's not, because you can actually...
See, I'll make a quick comment. I like the tinfoil hat theory stuff, because it seems like more often than not it comes true. So...
I always keep an open mind no matter what. You know, if
Yeah.
I don't know, it allows me to go investigate what's going on. So I take everything with a grain of salt and do some investigating.
Yep,
Grab a
that's what
comment
we're
over
here.
there. There's a comment from Arto, I think his name is.
Yeah, you
He
wanna read it?
says, I can't see it, but I read it. So basically what he's asking is why are people crapping on day traders? I personally don't crap on day traders because you're in the market to make money. If you're going to day trade whatever stock you're going to day trade. If you're not an AMC holder, whatever. I don't pay no mind to you. I don't have no problem with you. You do what you want to do. I know that some people hate on day traders. I'm not one of them.
Yeah, well, I think the part where they're getting the slack is people being told to sell their shares to go day trade. Like, I have two accounts. I got a main account long with AMC in it and a side account that I play options in. And that's pretty much it. I day trade with the options and I take the gains from the options and I buy more shares. And that's all I do. So day trading is not bad. I don't advise doing day trading on AMC because it's just one of them things. Like, you don't buy puts on AMC just because it hurts the people that are long. It's just, in my eyes, it's not morally right. But I mean, there is a way to do everything. Julie says if Biden doesn't extend the amendment from last June, things should start going up per Boss Blunts. Yeah, that's one thing I'll be watching for is what happens in June with that amendment. So that's definitely something important to watch. Let me pick this back up here.
Watch this in real time happen. In real time. In absolute real time. It's insane. Options are the tool in which market makers manipulate stock. Here's examples of when retail lost control. DWAC. I remember this vividly. I remember that DWAC had announced they were going to have derivatives, right? Went from $10 up to $175. All of a sudden they had options and everyone was jacked. They thought to themselves, yes, I made almost 2,000% on just stock. So now I can imagine, hooray, I can make maybe 2,000, 20,000%. I don't know, on the continuation, but you were wrong. See, the reason that this was movable in the first place is because market makers weren't manipulating it. 1,000%. Every time there's a stock that catches momentum and then options are introduced, you lost control. You're going to instantly lose control because of two things. They're able to introduce new supply, which decreases demand, and they're able to gain control over the situation. Another example is CEI. CEI, they introduced options. What happened? Dump. Retail lost control. Options are market makers' way of control. 1,000%. I would describe it like this. In an analogy, in a perfect analogy, think of the entire market as being just a huge sheet of music, right? Here's the music. You got notes here. Here's a note. Here's a note. And the market makers are just playing the Sith Lord Symphony, right? They're just playing along, having a grand old time. Well, what happens when you wipe out one bar of music? You're gonna have a couple minutes of maybe a couple seconds of bad music, right? It's not gonna sound quite right. But what happens if you lose all the sheet music? What happens if they don't have the formula to follow? What happens if they don't have the script? Well, then you've got chaos. Then you've got a loss of market maker control. Here's some examples: Prog, SPRT, BKKT, Ader, GameStop, AMC. The greatest example being GameStop. GameStop went from $5, $2 to nearly $500. To say this was not because of options would be a mistake, a grand mistake. There were surely some shorts that covered here, without a shadow of a doubt. It went from 200 and some % short interest to where it currently sits today, according to Ortex data. And Ortex was registering that previous 200% plus short interest, right? But they didn't all cover. What this was is a loss of control from market makers. What happened is retail, new money, pile drived into options. There was so much degeneracy, so many people on Wall Street bets just plowing money. As much they sold the fucking farm, they sold their kids, they sold their cat, they sold their sex toys, they sold their fucking everything, their bed, whatever. It was all gone. They dumped it into options. Well, what happens? You overwhelm the music. The music got dicked. It got fucked. Absolutely massacred. Now, I think that a lot of that was lucky. It was surely to some extent organized and smartly put together, or whatever. You can look at it whatever way you want. But in a grand way, those guys secretly found the formula to massacring, to execution of market makers. And it was to burn the sheet music. They burned it. They lost control. This is the greatest example that I think exists in present time, that market makers lost absolute control over the way that a stock goes. What happened? Well, if you don't have the music that lets you play, you don't have the sheet music that allows you to see how many covered calls you have to sell, how many stocks, commons you have to sell to be able to write short exempt volume, whatever, you get screwed. Another example, SPRT. I remember that this at one point in time had 3 times the float in the money in calls, meaning if there was 50 million total shares, there was the equivalent of 150 million shares, this being the float, by the way. There was 150 million total shares that were in the money on calls, meaning market makers had an obligation for 3 times the float that presently existed. What does it sound like to you? A liquidity crisis. It sounds like they made a bad decision.
Now, from what I understand, I thought you couldn't write a contract without covering it.
That's what I thought. That's my point, right? A free and fair market. If you buy a stock, there has to be a buyer. I think the same for the contract. No,
That's what I thought. I thought you had to have it covered. You can't just throw contracts out there. I know I can't. I don't have no right to go and throw contracts out there without covering it. So market makers definitely taking advantage of something. And how that doesn't get looked at doesn't make any sense.
for every trade, there should be a buyer on the other side or a seller on the other side. That's
exactly. So Trey's hitting the nail right on the head here.
Similar to 2008 and CDOs in terms of credit, in terms of liquidity, in terms of what they actually could withstand and could withhold in terms of supply and demand, right? They lost control of this. How is that possible? Options. Every single fucking one of these was because of options. Ader. What happened here? Same exact fucking thing. Same thing happened. Options ran way past the actual float in the money. Maybe it was 2 times, maybe it was 3 times, maybe it was 4 times. Market makers, sheet music got burned. They couldn't keep up. They couldn't print enough synthetic fucking shares out of the short exempt volume to keep up with what they already had planned out in their beautiful Sith Lord symphony, right? And they lost control. But they got it back. They got it back in GameStop. They got it back in CEI. They got it back in DWAC. They got it back in what is presently now GREE, but previously was SPRT. They got it back in BKKT. They got it back in BBIG. They got it back in AMC. They got it back in all these stocks. Why? Why is this the case? Now that we know, if you buy into everything that I've stated out so far, the theory that I have so far, right? If you buy into all of this, what's the grand takeaway? So that options market makers are always able to recover their music until they can't. What happened in 2008? Why do I think this is similar to 2008, right? In 2008, you had a credit crisis. If you wanted to look back historically at 2008 and look at CDOs and really what took place here, I'm going to pull this up for you just briefly. A CDO is a collateralized debt obligation. It's what contributed greatly to the credit crisis. Essentially, there was fraudulence in a very similar way to the stock market right now with market makers in terms of liquidity. Market makers compared to banks back in the day, and I'm willing to bet you money that banks have a hand in this presently right now today, were able to syndicate, create, and fake their way to whatever they wanted. Go watch the movie The Big Short. It's worth your time. I really, really do think it is. But back then, you see this in a collateralized debt obligation. Banks collected assets and created a structure to distribute the profits for those assets to CDO investors via credit. Well, what is a derivative? It's a leveraging tool, meaning that you can make more money from putting up less money. Well, how are you able to accomplish that? It's because market makers have the ability to leverage and deleverage and leverage and deleverage and leverage and deleverage. So if they have this ability and this tool and they're abusing it, what does it sound like? It sounds like music playing until it stops playing altogether. This is a situation in which the music was playing and it got halted, got burned. There was no more paper left to print. They couldn't create more sheet music. And I think that situation is going to happen again. My theory, my statement, my thoughts is that you are currently in a new liquidity crisis. What caused this? New money. You look at all the new money that came to the stock market in 2020 with stimulus checks and retail money and the millions and billions of dollars that came from retail and institutions, banks, and market makers. These guys haven't really known what to fucking do. I mean, genuinely. I think this is a situation where retail has actually done some damage in a good way. And what I mean by this is the market is slowly evolving. And the way that it's going to evolve, I personally believe, is being decided right now. It's either going to be a huge transferring of wealth from retail to banks, or retail is going to get to rewrite the game in complete time. And what this comes down.
Let's hope that's the way it works out, because I don't want to see it work the other way around where they take all our money. It'd be nice to see the rewriting of the rules. And I really think the people have the power.
I think if they try to take our money there, it's going to be a revolt.
I think pain will come if they go and steal from us on this play.
I do too. I think it's only a matter of time. They're going to have to figure it out.
But then again, this is just speculation. It's hypothetical. There's no way, like, you kind of got to take it for the way that it plays out and hope they do the right thing and give us the winnings. We've already beat them. They're already trapped. So with that being said and done, they have to do what has to be done, which is cover. And once they do that, we get paid. They can kick the can down the road, but who's to say that, like, during this midterm, a lot of the people that aren't doing anything doesn't get voted out, and we start bringing in some people that actually do something about the market. Who's not to say something like that happens? We got midterms coming up. That'll be the first game changer. What happens if new people go in there? You know what I mean? Someone's campaigning, look, we're gonna push to go and fix this market. Change the game that way. So it's basically a stalemate until we get to a point where one side wins, and that's pretty much it. Yeah, exactly. James says right there, we have the say. So
let me check Twitter and see if he just sent me something on Twitter. He might have.
Who?
KC. No, he didn't. He must have messaged you. I was just wondering where he was. He didn't make it back.
Yeah. So far, I think Trey's right. I think there is a chance that it could go both ways, but I think right now we're winning because they have no answer for buy and hold. We basically hunted out short sellers, saved the company, and we trapped them. I mean, there's nothing they can do. If I was a short seller, which I'm not, I refuse to be because it's like completely stupid. I get it. You get free tax write-offs if you can bankrupt the company. Sounds good, but I would never want to get caught in there because, there he is. As you can see what happened in Tesla, those shorts got blown up. I mean, bad. It wasn't a little bit. It was bad. And this is way worse. So you think the pain that those shorts went through with Tesla was bad. Wait till you see what comes with GME, AMC, and like all these other little, supposed meme stocks. I don't even know if I like the term meme stocks. They're like, end all be all stocks because like anybody that shorted it is toast. And they know it because they've been holding on, hoping for a miracle. And what they're using for collateral is somebody else's money. So, I mean, it does sound like we're going to get ours, but I mean, we just kind of got to hope that the regulators don't let them wiggle out. And I don't think they still can. I think they're still trapped and bound by contract. So it's like checkmate, pretty much. Would you agree?
Welcome back, Casey. No, I agree. I think that they're definitely trapped, no doubt. And I would say that anybody who is, below $14 in the stock, I don't know what anybody's average is, and it's none of my business. I don't necessarily care. I know what my average is, and I'm not selling. So, and I don't think the bottom has fallen out of it, and I don't think it's going to. Right? People that are at the bottom know what they have, and so anybody at the higher up range should kind of understand, like, if the bottom doesn't fall out of this thing, it's not going to really have anywhere to go but up. And that's my thoughts on it.
You
Welcome
think,
back.
Casey Shaw? What's your thoughts?
Hey guys. Well, so far on everything that he said there, the one thing that I just want to kind of point out is that he's leaving out a major key player on this, and that. Okay, guys, I tried to clean up my internet. Hopefully, it's better now. Is it okay?
Yeah.
Okay.
Yep.
Yeah, you're
So he's failing to mention the impact of long institutions and their whole role in this entire orchestra of hedging and back and forth play between institutionals. And that's the part that I think is probably one of the most key things you have to understand. And the reason for that is because there's two different ways that failure to delivers can be delivered, and one of them is through loaning of shares, and the other is to do exactly everything that he said so far in creating synthetics. And so that other part, though, of loaning shares is the key portion that I think that that they've not touched whatsoever. And I think that that's kind of the thesis that I'm the antithesis to this big squeeze theory that I'm throwing out there is there's been 4 times. I don't know. I wrote down the dates here and I pulled up the information before we started getting into this, but there's been 4 key periods of time, and you guys probably remember this, or at least on my show, people who watch my live stream know this, where they've come to within 1 or 2 pennies of hitting SSR for the day and never actually hit. And I wrote down some of the dates: 1/6, 2/14, 2/15, 3/8. And so the question ask yourself is who would stop them? Who would stop market makers from being able to create synthetics when we know that's how they get out of this this whole chain reaction that makes them a lot of money in this process? And the answer to that is the only person who could make money from that or does not profit from them triggering SSR is long institutions who lend shares to hedge funds and market makers. So because they're leaving that portion out, that's really a key thing that you need to understand is that those long institutions want to make money on the front side of a squeeze, because there isn't a single institution, there's not a single brokerage firm out there that will count on a squeeze. They make their money on the front side and they make their money on the back side of squeezes. And so our brokers are absolutely loaning shares out on the front side of the squeeze, and as long as they can perpetuate that cycle of nothing really happening and just being on the precipice of squeezing but not squeezing, they tend to make the most money because they're lending out shares and those shares are making them money. So that's one of the key aspects that I think that they're leaving, that's been left out of this DD here, that I think is absolutely critical. It needs to be talked about.
Yeah, I agree.
Because and I'll have a post that I made on Twitter that I could share with you guys. But if you take a look at the derivatives and the whole options chain back on 3/9, which I think the date that we started running was it 3/15? Or no.
5.
let's see, 315 was when we started running up this last run, right? If you look at the options chain for starting the week of 321, which was where the real big run came from, the derivatives were dry, completely dry. I have a snapshot because I do the stream every single day, and I pulled up on Stonko Tracker that had pulled up from that day on the video, and look back at the options chain. It was completely dry, the options chain for that week of 320, 325. So why did
But
we
the week
run up?
before,
The week before
they
was
burned
very heavy.
everybody the week before.
Yes.
Right, they
yes.
burned everybody.
Yeah,
We were
they
buying
burned
all
everybody
raw
the week
stock.
before. And so the price started ripping, and so you have to ask yourself, okay, so if price starts ripping when there's nothing left in the derivatives to be milked, and all of a sudden price starts ripping and everybody's FOMO's into buying options, and then next thing you see is this like huge push back down because everybody started throwing cash into the options. Is options really the right play to make? Because you're seeing the other side of what happens when we throw money into the options. They tanked it because long institutions tanked the price right here because they stand to make money on off the derivatives just as much as the market makers and the hedge funds. So so I think this is what we're seeing right here with this price run up and then the price run down is actually the exact opposite of what we want to do. And so that's my entire thesis is why does buy and hold work? Buy and hold works because we're not playing the game. The normal game is you buy shares and then you sell them when you lose. That's the normal game, right? But when you buy and you hold and you don't play their game, then they're forced to paying you, right? They're forced into a position to where they pay you. So if we play the options game, is that playing the game or is that not playing the game? Because to me, that's playing the game. And when you play the game, that's where money's going to be made because playing a game. So the question becomes, is playing the game the right answer or is not playing the game the right answer? Because we just watched the derivatives dry up and we ran up in price immensely. And as soon as everybody started playing into the options, the price tanked.
What if you're right? What if nobody played options and just bought raw stock? That would put more upward pressure by buying raw stock. That would squeeze them right up.
Yeah, and here's the other part too is a lot of people say like, well, was we ever buy and you don't. The other part that Trey mentions in there is the gamma squeeze in order to get to the squeeze, and I do not disagree with that. I want to be on the record for saying that we absolutely do need a gamma in order for us to rock it up. But now I'm convinced after what just happened a couple weeks ago from 321 to 325 that it's proof that a gamma will happen. The market will make a gamma happen without our movement. And the way that I can prove that to you is this. If retail's only responsible for 10% of price movement in the stock price, then how much do you think we actually move the options? It's probably about the same or less. It's probably less than 10%. So why would it make sense that if we start playing the options, playing the game, that it would cause it to do anything different than what it does?
Yeah, it does seem like options is the problem here, but like you do need them to make that thing explode.
But they'll make it explode though on their own because institutions want to make money, right? So if we don't play options, institutions will. Institutions
Exactly.
will absolutely make the gamma squeeze happen because they want to make money on the way up. Institutions will cause the gamma squeeze to happen all on their own. Why? Because they want to make money. The same reason that the whole reason buy options, because we want to make money. But if we stop playing their game, then there's no, I like to refer to it as cow to milk. There's no cow milk, and the farmer wants to milk the cow. If you don't give the farmer a cow to milk, he's not going to milk it.
Makes total sense. If they can't get money from us, they can't hold it down.
Yeah.
So my question though is who's driving up the implied volatility on it? Is it Is
Market
it the
maker.
market makers, or is it retail investors buying options? Do you see what I'm
It's the
trying to
same.
say?
Yeah, it's the same.
Who's
It's the same.
who's buying the majority of the options is what I'm getting at. And I would have to say it's probably market makers. I don't think
Yeah,
retail has that much effect.
and
Which
that's the same thing for buying shares, right? If we don't have an effect in buying shares, then why would we have an effect in changing anything in the options? We don't. We just have money to bleed off that they can take away from us, as seen with the options currently.
right, and that's kind of why I'm curious as to what they're talking about with uh, the historical implied volatility. Uh, of course, the historical implied volatility was low on basically all of it, including call options. They're just saying it for put options, but I think it was low for both. No,
Again,
historical implied volatility. Trey brought up a chart, right? And in the
Mhm.
chart, it says that put implied volatility was low, options implied volatility was high. But that's my question though. Like, is that how far back is we going historically? I mean, think about it. Are we talking a year? Are we talking 3 years? Right? There's a difference there because everything that's been going on in the past year and however many months it is now.
So the game has changed, and I think you can see it in the market and the way the prices moved. And I think it changed somewhere after November. Started running down. Normally, I think market makers or hedge funds. Normally, I think hedge funds have more control of what's happening with price. I've seen some very dramatic changes in the way that pattern trading has been going on to where it looks more like on and off switches versus the normal trends that you see in a stock price where it's very kind of like jaggedy looking. It moves up, moves down. It's kind of like all over the place. Where lately we see these big runs that go up and then down, or they go down and then up. And it's just kind of like it's either on off switches, right? Well, when
Mhm.
you look at how price is controlled in a marketplace and you're looking at a long institution, long institutions can only really control through dark pools where their orders are going through. So they really only have means of affecting price or discovery through their dark pools, right? So they effectively only have one means to control price movement, and that's through on-off switches. Hedge funds and market makers working in unison can cause price to be affected multiple different ways, giving it a much more natural trading. So, and if you look back, I was actually trying to pull up the dates here. There were specific days that I recall that we had where I saw the switch. Trying to find the dates again, but I want to say it was like December 4th, 5th, and 6th. And I'm trying to go back to that period of time. But there was like days. It could have been January 4th, 5th, and 6th. But it was during that period of time where there was a switch, and you could see where all trading on AMC suddenly went to either just on or, and it was just there was no like random. It was just either going way up or going way down. And I'm trying to look for that date. I think the date might have been. I'm looking. I think this is it here. December. It might. Okay, so this might be the dates right here. It was December 27th and 28th. I was way off on one of the dates that I thought that they were. You'll notice that December 23rd and 27th almost look identical. And then if you flip the pattern for December 23rd, 27th, I should just share my screen with you guys.
Yeah.
Probably help. And I have this on a
Froggy
15.
got you.
I got it.
I have this on a 15-minute interval, so it's a little less pronounced, I guess, than what you would normally see. But what you end up having here is on December 23rd, there was a very specific pattern that was set forth when it traded that day. And the very next day it had the exact same pattern. This was the first time where I first noticed that everything really started to change, because instead of having these like ups and downs and normal kind of trading patterns, all of a sudden you just had off, on, and neutral, off, on, neutral. And then you had on, off, neutral. And it was really funny because you could take the very first day right here, you could inverse this pattern and lay it over the top of this day right here, and you're like, holy crap, they just basically did the same thing, just inverse. It was almost exactly alike. And that's where I first noticed the big change. And it's changed a few times after, but I really do feel like long institutions are the ones that are in control. So when you talk about implied volatility and maybe how it's different now than it used to be, I would say that if there was a reason for that, it would probably be because of who's in control of price.
So my question though is, you think implied volatility is high because institutions that are holding long positions on AMC are selling covered calls and market makers are protecting those positions?
I would say that they probably just want more premium.
Right. So market makers
just
are
want more-
helping institutions collect premium, right?
Well, I'm not necessarily trying to help them, but I mean, it's obviously somebody wants more premium. If they know that there's more money out there to be made and they feel like they can charge more, they might be working in unison to try and milk the market. Sure. I don't know if that's necessarily the case, but it's a possibility. I actually don't know the answer.
I don't either, but it's an interesting topic, is what's actually going on. So I don't know.
I also noticed that Geo, I think the name of the person was Geo or something like that, said that if there's no gamma, then there's no squeeze or something like that earlier. I'm scrolling back to see if I can find that again, but yeah, I mean, we don't have to be the ones responsible for causing the gamma squeeze to occur, because the market will cause it on its own. So I think it's a mistake to think that we have to cause a gamma squeeze.
That's a good point, because they're playing options too.
Yeah, because you might be right. I mean, you might not need to have options to cause a gamma squeeze.
No. You need options, but not played by us, because somebody else is still going to play them.
Oh.
Yeah,
you made a good point, is what I'm saying too.
Let the institutions do it, and then
exactly
let the institutions do it. Let them do the dirty work, because they're used to it.
Yeah,
they're good at it.
That's what they do too. They use the options to try to push the market up, and it does seem like with us playing options incorrectly, they're stealing our money and beating them up with it.
Maybe that's what Trey, and maybe that's exactly what they're trying to say. I don't know for sure. Maybe that's why they're trying to say, if you buy puts, I don't think it's a good idea, in my opinion, but maybe that's what they're trying to say. If we put so much implied volatility on the put side of it, then they'll be forced to buy call options to bring, or create the gamma squeeze up. I don't think that it's going to happen, but I don't, but that's what they're talking about. I think that's exactly what they're trying to say, right?
Honestly, I struggle with what it is that they're trying to say, because I feel like I see the other side to it from the long institutions. And I'm still waiting to see a video. I know you guys said that Trey had a third video out, and I haven't seen that one yet. So that's the one that I'm still waiting to see, because I'm waiting to see some more clarification on what it is that they're proposing. If they are and saying that only experienced players should be playing the options, then I would probably tend, and I've always said this, if you win 80% of the time on options, stick to it. Great. I'm happy for you. Keep it up, because you're a winner. And I want to see retail win. But if you're not a winner, and you think you should suddenly start playing options, you can cause a squeeze to happen. That's bad news.
Chris, I kind of agree with you. That's what my whole point is, right? Chris Hamburg, I see your comment. He says, if apes buy puts, AMC goes to 1 cent. Right. I agree, because ultimately they're going to try, and push it down. You know, it allows them to get a lower price, but that could possibly also be a good thing. I don't know, but I don't want to see it get that low and take that risk, is my point.
Yeah, I see both points. I know when we got into play originally, it was never mentioned to go buy calls and try to push it up. We were basically like we basically heard just buy, hold, go long, and it will squeeze. There was no mention of options. Everybody took that up upon themselves, and people keep continuing to buy them. You see them. There's people buying like $10 out of the money, and there's no way they're coming in, not short term, and those aren't helping us. That's money going to the market maker. So, but let me keep pushing this thing here forward. We got a couple more of these to do. Let me get the right one though.
Down to me is who has the control. Control versus lack of control, right? Personally, I believe that market makers have moments in time in which they lose control. And I personally also believe that this is because retail is only playing one side of the coin here. We think too narrowly. Now, this is drastically different. Drastically different than telling. Let me dive into my theory first. Actually, I think there's two scenarios here, two ways that this ends. Right? Scenario one, market maker scenario, periodic squeezes. Not necessarily wrong, not necessarily bad. You're gonna have moments in time. I remember saying back in March of 2021 that I think AMC is gonna squeeze like Tesla. I think you apply that to everything: GameStop, BBIG, GRE. Bed Bath & Beyond, BlackBerry, CEI, all these meme stocks, all of these are going to do the exact same thing. They're going to go through huge reps where they lose momentary control of the market maker system, and then they're going to go through periods of long, drawn-out, slow fucking bleeds. I think that's very possible. I think we're coming up on a really nice 1 to 2 month rip for small mid-cap companies. I think you're going to see a squeeze across the market, 1,000,000%. But I think there's a better situation here. It's the retail situation. And this is the hard truth. This is where at the beginning of the video, I think people are going to mock me. They're going to ridicule me. They're going to be angry. They're going to feel all sorts of things. But to be frank with you, I'd rather tell you the truth. What the books say makes the most sense. I think the retail situation, the retail scenario where people win is very simple. You play the market maker game. We're not going to beat these guys. You cannot, unless you are able to create or present more money to the stock market than presently exists in market maker hands, which is trillions of dollars. You can't beat them. Retail doesn't move these stocks. They don't. We don't.
It's kind of scary what he just said there. If he can provide more money than the market makers control, that's a scary fact right there. Like, I don't even want to say fact. We'll just say that's a scary statement. I don't even know what to say to that.
I wasn't listening, to be honest. I was doing something at the moment. So if you want to rewind it or and tell me what he said, because
he's saying that they've got more money than we have, is what he's saying. I don't disagree with them.
They're going to beat us, but they definitely have more money than we do.
I don't disagree with him, and I've actually said on many occasions that, we at the most we buy maybe somewhere between 5 to maybe 6 million of shares on some of our best. And when you consider how much volume we have in a single day, that's a really small portion. Now, to consider the idea that, we're going to go up against market makers, long institutions, and hedge funds in a battle in options and think that we're going to get better than 10%. He's saying you've got 10 fighters over here in the share department fighting the fight over here, right? And we're going to take one of those guys from buying shares over here, and instead of buying shares, we're going to take that 10th guy and send him over to play options instead of fighting by buying shares. And so then I go like, okay, well, now you've just decreased your buying pressure. So now instead of 10%, we now have 9% of buying pressure. And some guys over to fight. If it's going to be an uphill battle. It's going to be an uphill battle, and likely not a very good battle, because you're sending them up against David versus Goliath. And I know David wins, but these guys are beasts in the market.
It's like they have never-ending pockets, right? Like,
right.
And I say that because they do have never-ending pockets. If you look at the big picture, right? The American people are ultimately going to be the people who pay the whole debt, right? When they collapse, they'll get bailed out by the federal government, which means taxpayer dollars, and ultimately we pay in the end, right? I mean, that's how I see it. Like, it's like never ending. Like, if you're too big to fail, right? That's really what we got here.
Well,
Just like in
here's a question
2008.
for you. Whose money are they investing?
Exactly.
Well, whose money are they investing?
Ours.
Our money.
Why do we give it to them?
We shouldn't be.
So that's how we win. We just take our money back and starve them out. If they have no money, they have no power.
Froggy, are you calling for a national strike?
Whatever needs to be done. No.
I'm not opposed to
That's what I'm
whatever
saying,
you
though.
said.
Like, they're taking our retirement money and they're beating us with it. Like, at what point do you just not boycott them and just take our money back and go to some place that ain't doing that?
Yeah, that's another subject altogether. I've thought about an idea of having starting a brokerage firm that apes RS brokerage firm that doesn't play the bad games and doesn't lend your shares out and gives you kickbacks for all the money that's made by the brokerage and all that kind of good stuff. But I mean, that's part of the game that we're playing is we're buying through our brokers, and our brokers are using our money to play the game, and that's what they're supposed to do. They're supposed to play the game, and we're paying them to play the game.
Yeah, pretty much. We're paying them to beat us up. Doesn't make any sense.
No, I know.
Then if we beat them, they take our money anyways because they get bailed out with our money.
The other problem I kind of have with the whole Trey and Astro thing is not that they're wrong, but I think it's bigger than that. I think it goes all the way back to the SEC not doing nothing, the DOJ, Congress really not doing anything about it, and allowing corruption to continue, right? So I think there's multiple things that we're kind of fighting a battle that I don't know.
I mean, you guys actually nailed it on the head, and that's what I've been trying to say from the get-go is that win a unlosable game is you don't play it.
Exactly. Don't play none of it.
Right. That's the true answer, and that's why buy and hold really works, is because you're not playing the game. You're not saying, "Oh, I just lost it, so I'm going to bail out of the stock and go someplace else," and just hand over money to people as you've lost money. You're buying and you're holding and you're not moving anything, and so you're not playing the game. You're saying, "Screw everything that you're going to throw at my direction, telling me that I should remove myself from this position. I am not playing your game any longer. I am going to just buy and hold." And then the algorithms have no way of dealing with that. And so the question then becomes is, do you start playing the game or not in the derivatives? And I think that the answer is no. And I would challenge Trey just simply because I know he's a good guy. And this is, I'm not trying to make a joke here. I know he's got a good heart, even though he's got a really bad heart, but I know he's got a good for our community. I know that deep down inside. I can see it. I played poker so long. I know good people from bad people. Trey's a good person. I really, truly, and honestly believe it. But if you want to help people in the community, there are so many more ways to make money in this market than telling people to go play options on AMC. There's so many other stocks out there that you could be showing people, And I feel it deep down inside, Trey. I really do. If you ever hear this, Trey, I know there's people in this community who are struggling. I've seen it firsthand. I get the same kind of emails that you out, and it hurts. It hurts to see those kind of emails. It really does. And I understand. Playing this game is not the right game to play. There's other options out there to make money in this market. And it doesn't have to be about playing the game with the institutions. There's smarter games to play.
I do agree with him that an informed community is a better community, and that education is much needed. And I think that's what we're trying to really do now, right? Because there's a lot of people who don't understand any of it.
Right.
There's a lot of stuff I still get confused on, honestly. So, I mean, I'm not perfect, and I don't claim to be.
Yeah.
I want to get a couple questions knocked out and out of the way here. We got Chris says OBV proves apes are not selling and haven't sold for a year. I don't know enough about OBV, but I'm pretty sure Casey Shell does. Is that what it indicates?
I don't believe so. I don't believe so. And in fact, I know that there's apes who've been selling. In fact, you can see it. All you have to do is pull up with Fidelity, for example. You can look at the order flow ratio every single day. And for the last 2 weeks, when we had this run up, while OBV still held really good numbers, we had more selling in order flow than we had in buying for about almost a 2-week period. In fact, Thursday and Friday were the first we started seeing over 60-40 buy to sell ratios, which is that's at a very bare minimum. That's kind of the number that I want to see, is over 60-40 ratios, because it tells me that investors are buying more heavily. I mean, because you don't really know how many shares are involved in each one of those orders, but you know that the ratio is high. 40 looks really good, and we've both Thursday and Friday this. But for the 2 previous weeks, we've been seeing numbers down in the 50 or lower than 50% range on buying orders, and I know apes are selling. When I see numbers like that, I know they're selling. Now, are there still apes that are buying? 100%, because we have, it says E3, 43% buying to 57% selling. Well, guess what? Somebody out there is selling. Somebody has to be, because you can't have an order flow ratio like that and not have apes selling. Does it mean it's the end of the squeeze? Absolutely not. Not at all. And OBV is a great indicator to prove that there's enough volume to withstand a price movement downwards. So I do agree that OBV does show that we have good amounts of volume supporting our price level where we're at, and actually a higher price level, but it's not the end all of all indicators that shows you as to whether or not people are buying or selling.
I know we get new waves every day because I've met some new people, but yeah, I don't really know, but I don't think the bottom has fallen out of this thing at all. I think the people on the bottom are still holding.
I do too. I think there's a lot of people that are holding.
Now, here's a question by Arto. It says, but guys, people that have bought and held, as everyone says, is down 70%. Not everyone's down 70%, but I understand what he's saying. How do you convince these people to stay in anymore? It's easy to buy and hold below 20, but what about the rest of us? The way I look at it is, like, I'll probably still buy all the way up to about 100, I think. And that's only because, like, I'm probably one of the stupider ones, because I keep looking at it saying, if I could pay a Benji for it and I can get 10 Benjis or more back from it when it's over, to me, it's an investment. And I might even keep buying all the way up through. I don't even know. But that's the thing. I keep looking at, if whatever I pay for it, the end number is worth at least 1,000. Like I said, my target is 5,000, so I'll probably keep buying all the way through. Once it starts ripping, I'll probably stop buying. But I mean, I'll just sit back and just watch the numbers and probably panic like everybody else. But that's pretty much it. I mean, if you bought at 70 and you know it's going to go, at some point you're going to get a squeeze out of it. As long as even if it's 700 or 1,000, I'm not saying that's what it's going to go to, but that's 10x your money. And who wouldn't pay $70 for 700 bucks?
Now, I would say that my philosophy, and it's a little different, I guess, than most people would say, right? If I was in that position, people call you a bag holder and all kinds of other crap. You know how the short sellers go, but I don't like to lose money at all, right? So if I think I'm in a decent play and I think it's worth something, I buy more shares to average my position down. That's just what I do. So, in fact, one of my brothers is in this same play, and he's in at a higher price. Okay. So I tell him all the time to average down, buy more shares, right? So I'll give you an example. I'm just going to tell you what he has, basically. So he's got some shares at $60 a share. Think like $2,000 worth. I don't know how many shares it ends up being, whatever. So when it's down at this range, if you bought 2,000 shares down here, it would cut your position in half, pretty much. And then you could go on from there. So I'm not telling anybody, I don't give financial advice, but that's what I would do if I was in a position like that. And if you don't have that money, I'm sorry that you don't, but all I can tell you is people at the bottom aren't going to give up their shares, right? We know what we have at the bottom. I personally believe the stock, if none of this was ever going on, is worth between $25 and $30. It's a good company. I understand we have debt, but that debt has been negotiated and it's going to be paid off. So to me, I think the stock price should, on a regular market, should be around $25 or $30. So I have a decent entry price. So I'm making money either way. Right now, if I sold, it would be at a loss for me. So you have people like that at the bottom is my point. I would just say that's all I really got to say about it. What do you think, Casey?
And I'm gonna throw Trey some credit right here, because I'm not a Trey basher. First off, I'm gonna tell you guys that one of the very first times that I had ever I got in at about $14 in January. Well, by the time I got in at 14, but actually I think it was late January. It was like January 29th, but I actually doubled down. I don't remember exactly what the date. I do remember the price. It was $6. It got down to $6 watching Trey, and I had kind of come to the decision. I was like, you know what? I believe in what it is that we have here. I know that this stock is worth more, and I see the data, and the data tells me that I should be going for this wholeheartedly because I believe in it. And then the very next day, Trey put out a video and he said, I'm doubling down on this, even it. And I was like, damn it, Trey, I'm with you. I'm totally with you, buddy. Let's do this. And so, and I had already committed to this, and it's live, and then getting off. And but I didn't care. I didn't care that I got in at 6, and you know what? I've been averaging up ever since. In fact, I just bought more shares last week. So when people sit there and tell me, like, how can you sit there and expect people to hold through this? Yeah, sure. Maybe I'm in the money right now, even though I've been averaging up along the way. But I know that there's people who are holding in much lower than I am and have way more shares than I have, who are still holding this. And that should give you the courage. You can find those people. There are people that are still in this who still believe that this is going to go much, much higher. And so I don't know. I can't give you conviction. You have to find conviction in what it is when you decide to get into this play. All I can tell you is that at some point I decided to start averaging down, and then it became averaging up. Now you have the money to afford, and I always say this, you should never invest with money that you can't afford to be without for some period of time. Don't just sit there and throw money at this. I'm not saying that at all, but I am saying if you have a chance or an opportunity to be able to average down on this, this is time to be able to do it. It is. It's right now. And maybe not right now. Maybe it's in a week or two from now, or whenever it may be. I just buy and I hold, and that's all I have to do. There's nothing more to it. It's just not complex. It's really not that complex. I give Trey credit though. credit. I give Trey credit. he is he was the one who definitely made me realize that what I was doing was correct. And so I don't want this to be all about bashing Trey by any means. So I'm giving him credit now. And
No,
that's
I
the
don't
whole
think
reason that
anyone
I'm
here is
confirmed what it
bashing him at
was
all.
I was believing. Yeah. Well, I don't want anybody to think that we are. That's not what I'm here to do. I'm about it.
Yeah, me either. Exactly.
Let me see if we got a couple other questions here.
Yeah, pull up Jordan's question. I seen it. I'm interested.
I'm not sure which one that is.
Jordan says, I'll tell you. I'm not going to say his whole name because who cares, right? It's pointless. But Jordan says that YouTubers are all bag holders. And I laugh at that. And I'm not afraid to show my P&L, so whatever.
Arthur says, do you guys know data-wise who has more shares, institutional or longs or shorts? Not sure.
Who has more shares?
Yeah.
Yeah, long.
He's having internet trouble again.
Yeah. Oh.
He'll be back.
Yeah, give him a second.
I'm not sure on this one, Froggy.
It depends on what you want to count as shorts because, like, it's self-reported. Oh, there he is.
You talking, Casey?
No,
We see you.
I lost you guys again. I might have to get rid of video feed and just put me on voice because for some reason or another, everybody in the neighborhood wants to use there now. It's the weekend.
That's fine. That's fine. Yeah.
I hear you. Whatever you want to do, whatever's easier.
Did you guys ask me a question? I didn't hear it.
Yeah. Do you guys know the data wise who has more shares, institutional wise, longs or shorts?
Longs should have more shares than.
I agree.
I'm not sure because they get to say what they have. They don't have to necessarily tell the truth, right? They don't report everything.
Right. Well,
what's Ortex reporting? 85% or something like that.
So here's the thing: they can't lend that they don't have, or supposedly. Unfortunately, I caught them red-handed doing. So I think on the books they have to show that they have shares. So, and I don't think excuse me, I don't think that hedge funds own that much.
market makers, hedge funds do short, drive the price down by options. Also, market makers, hedge funds play married options, which is equal to calls and puts, which are illegal. I'm not very familiar with married options, and so I can't really make a statement on that, but I do know that they take advantage of every little loophole to drive the price down, and they've been doing it. Do you know anything about married options?
I don't.
Okay. Midterm elections are coming, so the market will go up. Yeah, they need to convince people to vote them in. We got all this inflation, markets acting shady. I mean, it's going to be a tough campaign. What are they going to say that they did? They didn't fix anything. Everything's kind of gotten worse. So
That'd be
Are we gonna-
interesting.
Are we gonna watch the rest? I'm curious. I just was continuing to watch any more of the videos or.
yeah. Yep.
Come on, Froggy. Let's get this thing going, man.
It's mathematically
Still on the
not
first
possible. We
video
don't.
here, guy.
We don't move the stock. Market
I know.
makers do. Institutions do. Banks do. These guys move the stock. We hold the stock. The float is ours. It's locked. So who's moving the fucking thing? It's not us. It's not us. We're not moving this thing. We're not. This comes down to market makers, banks, institutions, and all the fraudulence that I personally believe is happening, right? So how do you beat them? You play their game. I personally think that if you wanted to end this in a month, you wanted to have your huge, massive rally, you play the market maker game. What does that mean? It means if market makers are loading, and this is drastically different than selling your stock, right? In no way, shape, or form am I telling you to sell stock, but let's present an if this, then that scenario, right? Let me present you this. If the stock price, historical volatility compared to current implied volatility, you see cheaper puts, you're likely going to see downside. Market makers are loading up. The stock price starts going down. They're trying to make money on the downside, right? How do you play their game? You fucking pile drive them to the downside while also holding your stock. This is important. This is a hedge. This is not going short on your company. This is hedging against the inevitable downfall, if that is to happen, right? And I'm not saying that right now AMC stock is doomed to go down to $1. That's not good. It's got doomed to go down to 5, 10, whatever. What I'm saying is you're going to have periods of time of just by the books, by standard, by the way this thing moves, huge rips, huge dips, huge valleys, peaks, valley, peak, valley. This is going to repeat over and over and over in the way that I think Tesla currently squeezes. They're going to see that. You're going to see these massive waves and rallies, you know? So I think the way to win is to hedge. When market makers are pushing it down, you play the down while also holding your stock. You hedge against your position. What happens when you exit that put at the bottom? You made your money, right? Market makers are going to start leaning towards the upside. Why? Because nobody's playing the upside, which means that the implied volatility is going to go down, which means that the options contracts are going to be cheaper. They're going to push it up. You have all this extra money that you made from puts while also holding your stock. You're not selling your stock. You're holding, right? If that's what you'd like to do. Of course, I'm not a financial advisor, whatever. You have all that extra money. You either buy stock or you buy calls. It goes up. You beat them at their game. What is the way to permanently burn market maker music? There's two. You take it into your own hands. Or the law steps in. If you look back in 2008, the SEC never got involved. Never once. They were tipped off many times. People saying, hey, look, this is fucked up. Didn't do a thing. What it came down to was an actual criminal charge. Big boys. Federal crime. Not the SEC. Big boys, right? The gears of justice grind very slow, but they do in fact grind. Law stepping is possible, but I don't think it'll be the SEC. Option one, retail plays the game. I think that's genuinely what it's going to take. I think that we have the right idea, right? I think retail has the entire right idea. I think the thesis behind buy and hold is a huge reason why these guys are in such a shitty boat. I don't think the premise behind people loving a stock, they decide to buy a stock individually as is, and they hold it no matter what comes. You know, if that's what you want to do, I'm not telling you to buy, I'm not telling you to sell. You do what you got to do, right? But if this is the thesis, I don't think this should change, because just looking at it with a completely unbiased perspective, this is what has created the liquidity crisis. This is what allowed us to be able to look back and say, yep, these market makers are pretty fucking crooked. They're pretty bad people. The problem is you are only trying to move this thing up, and you're only playing calls. When you want to play calls and it's going up, make that cash. Make it. But when the stock price is going down and it looks like it's going to continue down, right? Make that cash. This is how you burn market makers. I really do genuinely think that. I do. I think that's the solution. I think this is a lot to digest, and there's another video that I'd like to throw together regarding this theory, regarding these thoughts. in a new video. I expect, I think that some of you are probably going to be frustrated. You're going to say, Trey, have you lost your fucking mind? And so be it. I'm taking this from an unbiased perspective. I'm taking this out of good heart. And I think those who've watched me for a long time know that when I say something, I mean it. I wouldn't make this video without some real thought construed and put together here. And at the very least, I think this is interesting. If I have any final messages, any final thoughts, I'm not telling you what to do. I'm not telling you to buy, to sell, to play calls, to play puts. But I do think it's time for retail to think outside the box. We can only bang our head against the door so long until it's time to try something new. And I think this is a genuine solution. It's time to evolve. And that's what I've got for this video. Let me know what you think. I openly welcome good discourse, positive discourse. I'd love to have a conversation about this. I'm going to read the comments very closely. You let me know what you think. And I'll be making another video soon. Catch you all later.
So, I mean, he might not have actually said to buy puts. You can see it here. If this wasn't AMC, what he's saying would make total sense. What makes it hard to digest is the fact that this is like our main play. Mm-hmm. And that's the only part that makes it difficult to digest, exactly like what he was saying. And if it was any other stock, I would agree with it.
Right, because you don't have a buy and hold mentality in any other stock. You don't care what happens to those other stocks. I mean, it sounds so bad, but I mean, that's really what it essentially comes down to is any other play that we've ever done before, we don't care what happens to it. We just do something and try to make money. But in this particular instance, we are buying and holding, which is us saying that we care about something so much that we're willing to put ourselves through misery to win.
Yeah, because the one thing he is right about is, again, if it was another stock, but he's right that if they're shorting the stock down and we buy puts on it, then you're taking money away from the market maker, right? So they're going to make less money if we did that. That is a fact. But that their end goal is to drive the price down. That's the problem we have, right? So I don't disagree with what he's saying, but I don't think it works for what we're doing. I mean, I do work for myself. I do my own stuff, right? But I'm just saying, we all have basically the same mindset. Nobody tells me what to do with my money, and I don't tell nobody to do what to do with their money. But
I want to read you guys an interesting fact. Calls out of money yesterday on Friday. 239.7 thousand contracts. Puts out of the money. 53.6 thousand contracts out of the money. In the money calls was 5.2 thousand, and in the money puts was 49.6 thousand. Both the puts and the calls were way out of the money, there was more out of the money than there was in the money. It is a very, very dangerous game. But the point that I want to make is that is an extremely options chain, extremely loaded. Mm-hmm. And what did we see happen when that happened? We saw the price drop this week, the entire week. Tony Denaro had me mediocre. Were you on that channel also with Tony when he put us to the test or was it you, Froggy? I can't remember who all was on there, but he asked us what did we think we were going to see for a prediction for the end of the week this week. I said green. I know Tony said green. I forget who the other person was that was on there, but I'm pretty sure that we all said that we thought it was going to be green this week. Well, look at the options. Look how many of them are that are expired out of the money, and we went red. Is options really the play, or is the market going to try and cause the price to go the direction that causes most pain, regardless of where the options are played?
Well, if you remember, back when we first got into this play, Reddit was calling this out a long time ago, that they were going to use max pain and everything else. They called out everything ahead of time and said max pain, and all this goofy stuff that was going to happen, married puts and all that stuff. And they're doing all of it. They called out FTDs. It was before June, and everything was mentioned before. And it's like, how did they know? Like, once you get them up against the ropes, this is what they do. They go into like panic mode and they abuse the game.
So this all started with DFV. Would you guys agree with that?
Yeah, pretty much.
Yes.
Would you say that the blueprint that DFV laid out before us is the blueprint that we should be following?
I think that I don't disagree with you, but I think that we were similarly, I don't know if we were exactly trying to follow that, but I think that the hedge funds and the market makers all have come to realize that and have changed their plans as well. Right. So I'm not saying that it won't work. I'm just saying it's interesting, but I know where you were going with this because we talked about it.
Yeah.
So go on.
He did buy options. For those of you who aren't aware, he did buy options. I'm not 100% certain. I'm still trying to port his information. That's kind of my weekend projects right now, to try and figure out exactly what he was doing with his option play. But my understanding is, based on things that I've heard from other people, is that he bought mostly really far out long calls during specific periods of time where he knew price was going, and then he cashed in on those. So I don't know. I mean, we have a blueprint that's been set before us and one that works. I don't know that we necessarily have to change the playbook.
Now, this is the exact reason why I wanted to do this video right here. We got comments coming in from Rob. He says he's an options trader and one who has more experience than most in this form, and can tell you by playing both ways, it does not help the MOAS. The MOAS MOAS only happens because of gamma pressure or a catalyst. So, and that's my exact thoughts too. Like, I understand the hedging part. Like, you can skim money, but it does seem kind of weird where you're not putting constant buying pressure on something to take like some of your long money. Instead of putting it in there in longs, you buy puts and then push it down. I get it. You could skim money, move the price back up. But, I mean, what he's saying here, it doesn't seem to be helpful. That's where I'm kind of conflicted. I'm like kind of torn between both thoughts. I understand both thoughts. I'd rather just buy and hold and go long.
Right. If everybody did exactly what Trey's saying, we've discussed this several times, we keep coming to the same conclusion. And I don't disagree with Rob, because if everybody bought puts, right, when they started driving the price down, they're quickly going to reverse it and go the other way, and everybody's going to lose their position. I would think how they would do it so that you don't make no money on your puts. Right. So they're going to do the same thing, just in the opposite direction.
Exactly.
I don't think that's necessarily going to help the price to go up. Maybe a little bit, but they're going to just create a new strike price or a new, what the hell's the word I'm looking for? I can't even think of it. I hate when they have that.
Senior
At
moments,
the end of the week,
yeah.
on Fridays. Yeah. At the end of the week on Fridays, but they hit that spot. Come on, I can't think of it. You go to the website, you look it up. Max Payne. God damn
Max
it.
Payne.
I hate when I do that, dude.
I think that we just sit there and let you stroll.
Area. Yeah, thanks. Appreciate it.
Hey, man, we're here to support you. Dead silence.
Thanks, Jeffrey.
Yeah, Rob's pressure and only pressure will push this, and that's why I agree with 100%. Just because, like, I'm not trying to bash Trey at all. Like, I like the ideas that are coming up, and it makes you think, and that's why I put this together, because I wanted people that actually do trade options to come together and, you know, figure out, is there something special here or is there not? Because if this is actually a legit thing that I mean, he's sticking his neck out there. He obviously believes highly in what he's talking about. And if there is something to it, we should definitely listen. And I don't know if I'm just like old school or what it is, but I'm still stuck on the buy calls, buy alongs, and push. And that's the hard part is like I see what he's talking about. It makes sense. They're driving it down, like buy the puts, make the money, take it and put it into the stock instead of chasing them little fake squeezes that are being popping up. You know what I mean? Those things that they keep popping all over the market to try to trick people into jumping in them. I see what he's saying, but when it goes up, you're gonna lose that money for your puts anyways. So, and maybe that's what he's looking at is they'll have to make you money one way or the other.
So I got an interesting thing that I wanted to say, and it's kind of, I think it's pretty much fact, but the reason why you have to have a margin account, to buy a short position is because most of the market is long, right? Like there's a long bias in the market where everybody's going up. There's more people, there's more institutions going long than there is short, right? And I think that's why it's part of what they're talking about is with options. If you force them to go long because they're not making money, I'm just speculating. I don't really know that that's what they're thinking is, but
Oh man,
you know,
I'm just reading through the comments over here, and Dave Bala just said, what Trey is saying is proper trading strategy, but it's not our trading. I stand see this. This is the exact what we're doing with AMC and GME is the exact opposite of everything that we have ever done normally in the market. It's the exact opposite. We're doing the things that you don't do. And so this is, and what he just said there is the exact truth. If you want to win this game, you do the opposite of what you're supposed to do. You do the exact opposite, which is don't play the game. Just don't play the game. Be the house. Don't be the player. Right? For so long, these institutions have been the house, been the players. And we finally figured out a way to become the house. And it's by share ownership.
Well, typically
Go ahead.
Go ahead.
No, go ahead.
Typically, we get beat up with the margin call stuff because they give people margin and then they tank the market and then they margin call you and suck your money out of you. And they do that as a trap. Now, they use the options as another way to beat up on you. What if we just bought raw stock and never said, like, just kept driving it up until it got to that point where it was unbreakable? Wouldn't we still win anyways? Wouldn't that force it to keep escalating over time?
Wait, say that again. I'm not sure if I followed completely.
Okay, so what Rob's saying here makes total sense because we watch people getting blown up on options every week.
Mm-hmm.
And he says they're killing retail on options. Well, what if we didn't play the options and didn't give them any money and just bought raw stock? And like you were saying, just let the institutions battle out the option chain. Let them waste their money. Wouldn't that just create it anyways?
It would. That's my whole point is that the, and Gio said this earlier, we need a gamma in order to move up in price. In fact, a couple of people have said that in the comment section, and the market will cause a gamma all on its own. There are people in the market who want to make money. There are institutions that want to make money on this. And so they will absolutely cause the gamma squeeze to occur without our participation whatsoever. Because just as much as we don't affect stock price movement, we just are a tool to be used in the derivatives market. A tool, we're the low-hanging fruit, in fact, the industry that I come from, they always call that the low-hanging fruit. You always go after the low-hanging fruit at the end of the day because You're trying to get your moves, you're trying to get whatever it is that you're trying to get. So you go for the low hanging fruit, and that's essentially what retail is in the market. Is we're low hanging fruit, and the market will always go after the low hanging fruit first because we're easiest.
I agree with that.
That's how it feels like, doesn't it?
Yeah,
Is there? Do you guys believe there is long bias in the market, like overall?
What do you mean?
There's more upward pressure in general on all stocks, right? Most stocks are, most people go long, most institutions go long.
if you
I
look at
would
the
think
SPY,
so.
I mean, if you look at the SPY, you can't disagree with that. But do you think that? Let me ask you in a counter. Do you think that it's unnatural pressure? Like, do you think that it should have a correction, or it's overdue for a correction?
No. I definitely think corrections should be happening for sure, because if we didn't have corrections, then, well, just look at the SPY. You look where it was in 2008 and where it is today. There's a big difference in that, right?
Mm-hmm. I mean,
And
I would have to agree with your question for sure. Absolutely.
so it's just, I think that the majority is long bias, but when we have a short attack, it's much bigger in a shorter time frame.
Now,
That's all.
see, this is exactly what I was talking about right here, and it sounds cuckoo when I said it, but it says, let me say this: in the money options are gold. I mean, like right at the strike, just inside the money, because they have to delta hedge those. And when I said that, that's where the institutions put theirs. They don't buy out the money; they buy in the money nearest the strike, and they do that so they can get delta pressure. And like, yeah, it does cost more money, but there's no reason for anybody to buy anything like $5 out the money, because they don't want it to go there to give you all that gamma. So that's why they hold it back. And what he's saying here is stop buying them stupid ones that are way out there, buy more in the money and help it build the pressure. And that's exactly what I was thinking about, because like I don't think they delta hedge out the money calls at all. And that's how they control it. If they are still in the money, they have to cover them.
My only fear on that is that if people don't exercise those calls before they're out of the money, then they could lose. They're just basically throwing money out away. It's just you're just handing money over to somebody. So you have to exercise if you're going to buy options that way in the money options, and exercise those. Probably the best way to apply pressure on market makers, to force them into buying shares from the market, but it's going to cost you a premium, and you'd know that going into it, and you'd need to exercise immediately, because if you give them a chance, even they could drop the price enough to where you're now all of a sudden out of the money in a single night.
See, Rob here again on point. They're building liquidity by basically taking out the money options. They're sucking up premium left and right, and you can see that with Max Payne. So he's right there, and then like right here, I have a strategy. Options is killing the MOAS, but I mean the MOAS is still here. It's just we're not getting the momentum. It's not going to go away until we do the right thing. We have to do the right thing to push this forward. So they're trapped no matter what. So it's not killing the MOAS. It's just not. We're running out of momentum and have to keep starting over. But the MOAS will start via options because it has to be buy in the money options, which is 100% true. That's how you get that detonation from week to week with that gamma ramp that pops up. You get more and more in the money options. So instead of waiting for them to come into money, just put them into money, is what he's saying. So you're guaranteed to have that hedging effect that happens Monday, Tuesday, if they don't hedge them like by the end of the week. So what he's saying here, they are basically shooting fish in a barrel right now, which is, they're just sitting back, reeling it in, eating all the premium, and they're probably just having a field day doing it.
Mm-hmm.
So I believe that 100%. So, I mean, how far in the money do you have to go so they don't push the price down to go and wipe those out? I don't know, but I think he's right. Let me fire up this one here by Astro. Let me check and see if there's any more Rob comments here. Options is the worst enemy of retail, but will be what causes the MOAS. I'm certain of this. Yeah, you do need the options. They have to be in the money. They are technically worthless when they're outside the money. You can make more money that way, but you can't make any money if it doesn't move that way. So I think he's pretty much 100% right. What do you guys think?
I think we need some sort of a gamma squeeze to get things moving for sure. I mean, and I think it's going to happen. I just don't know when. Like, we're getting close now. We're in a real good tight wedge right now, so I don't know. It's about to break soon.
That
Yeah,
what you
would
just
think.
posted up there is a perfect example. Sounds to me like Rob knows exactly what's going on, and this is exactly what I posted. Everybody started buying options out of the money, trying to collect on their on the way up. And what did the market do? The market said, "Oh, that's what you think you're gonna do? Yeah, let me just show you how this really works." And they
That's
just
exactly what happened.
yeah, they just started dropping the price. And so that's why I say, like, if you just stop playing, don't play their game. Let the institutions play their games amongst themselves. And it doesn't cause them to push the price down, right? Because we know that there's more long institutions involved in this than there is short position institutions, right? So it only benefits long institutions to raise the price, money to be made elsewhere. So once there's no money to be made elsewhere, they're going to just let the price rise because it benefits them.
Yeah, it makes sense what he's saying exactly. I actually kind of like that strategy more. I'd be more down for buying deeper in the money calls, like a couple months out, just to see if it would actually make a difference, because it can't really hurt as long as you give yourself some time, and they have to at some point hedge for it, you would think. How can you guarantee that they're delta hedging?
So Gio's saying we need to watch that third movie. So Gio's trying to get us and push us here. Let's start watching a little bit here.
Yeah,
Enough
I
talk.
got the Astro one right now. This is the other part. Unless you want to skip go right to all the trades ones.
I'm Astro's first video, and I saw Trey's first and part of his second video, but I haven't seen the third.
Of Trey?
Yeah, I've seen Trey's first and part of his second video, but I haven't, and Astro's first, but I haven't seen anything beyond that.
So you just want to skip to the third one?
I kind of would like to, because I feel like that's his most current position, and how long is that one? Just out of curiosity.
It's shorter.
Yeah. I mean, that's
all
his
right,
current
let's fire
position.
this one up here and see, because I think what he did in the second one was basically like he redefined what he was saying and kind of redefined his statement on what he was trying to say. But pretty much the same thing as everything on the first one. We already understand what he's saying. Let's see his final statement or final video.
3 days now, I have worked on sort of a 3-part series, in which I call the Big Squeeze Theory. And the 2 first parts are out. And this one's going to be a TLDR. I've sat here and I've thought for a long time about the best way that I can sort of wrap this up into as short as possible of a video, because obviously people don't want to watch a half-hour long video. So I've summed this down, right? The number one question, the number one thing that I could see people saying is why puts. So how about this? All right, I'm gonna slim this down. We're gonna trim off even more fat. And I want to make this even easier, because I think that, the ultimate question and the ultimate concern, ultimately, and justifiably so, right? 1,000,000% is why switch up, buy and hold, right? So here I've got 2 scenarios. Here's a TLDR. If you want to see the in-depth analysis of everything that brought me to this conclusion, watch the first 2 videos. This is a playlist. There's 2 scenarios here. There are those who buy and hold, right? And there are those who play calls and buy and hold. This video and the previous 3 videos are not for those who simply just buy and hold. If you are a buy and holder, I genuinely believe that the easy fix for you is going to be just not paying attention to the charts. I think that's genuinely important, right? That's a huge piece of this. This video, the previous 3 videos are for those who feel emotionally drained. And let's be honest here, I can see it on Twitter. I can see sentiment on Twitter. I can see sentiment on YouTube. I can see sentiment on Reddit. I pay very close attention. I try to stay in touch with everything going on. Let's focus here. Let's focus on those who have played calls or do actively play calls and also buy and hold, right? Let's talk about the algo. Up rips and down rips. What is one thing that you notice with AMC when you pay attention to sort of up rip situations, right? What you're going to notice on up rip situations is that they happen extremely fast. This would be what I would call an acceleration. The algorithm likes to speed up and move very quickly when the stock goes up. You can be thought of as, you can explain this as a gamma ramp. You can explain this as some shorts covering. You can explain this as the algorithm just goes haywire, whatever, institutions buying, whatever. But one thing is apparent, volume is always very high on up rips, and it always moves extremely quickly. You can see this back in June. You can see this back in January. You can see this here in March, right? High volume, high speed. It happens. What do the down rips do? Down rips are super slow. Typically, what you'll notice is that volume decreases on down rips, and that down rips last a lot longer than the up rips do. Here's a slow down rip, very low volume down rip, and then it comes into another stage of an up rip. What is the psychology behind this? If you want to think about sort of the easiest possible explanation, market makers want to make money. They typically do 2 things. They will play, they will sell calls, and they will sell puts, depending on where it makes sense to do these 2 things. I'm actually going to have an in-depth options masterclass tomorrow that's going to explain everything that I know about options. I'm going to follow this up. I'm going to give you guys the resources that I think are important. But they want to make money by selling calls and by selling puts. What's the ultimate goal of this? To collect premium. Where do they get this premium from? Those who are buying calls and buying puts, right? Now, if you think about it in this manner, you go back to my previous 2 videos and you notice that calls are always higher in overall volume than puts are. That means that there's going to be more overall premium for calls than there are for puts. The psychology behind this, if all of a sudden call volume slows down exponentially, what you're going to notice is that it enters this fast-paced up rip. What is the point of this? It is to get people to begin buying calls again, right? Now, this isn't inherently a bad thing. There are opportunities to make money, and I think that calls are genuinely important, and that's why I hammered down on this. I think that calls are genuinely important.
Yep.
Can I make a very important observation that I haven't mentioned yet?
Yeah.
And perhaps you guys can help me with this. First of all, you know, if maybe you guys can help me with this. If you're going to be for example, you're going to be more than likely a margin account, I would, right? Obviously not going to want to have that as part of one of the accounts that you have long positions, long shares in, because let me ask you this question. What happens if overnight the price starts rising really fast, like he's saying, these up rips that are really, really fast, and you've got a put position in place? And we know, historically speaking, most runs really happen in the aftermarket hours and market hours. So if price rips and you have a put position, please tell me what happens to you.
You get smoked.
What do you get smoked for?
Premium. Your premium, you lose it.
I think they take you out of your long positions and cover your short position, basically is what you're getting at. But I would just want to say that you are correct when it comes to margin accounts, but there are also people with cash accounts, and you're playing with your own money. So
I see what you're saying.
It's like I only play with my own money. I don't play. I have no margin account. But you are correct in if you are in a margin account and it rips up. Well, no, you only lose your put position. You lose all of it, right? But if you were shorting it, what you were saying is you would have to you would owe because it's an infinite loss, right? If you were shorting it. But with a put, it's not an infinite loss. It's only what you the premium you put up for it. Froggy was right.
Okay, so you usually lose all of your premium, and as price runs up, that's it. Just the premium.
That's it. Yep. Just whatever you put in, you lose it. Because it's going to go to zero if it runs up. Because you can hold it to, and it could come back. Like say it moved up halfway. Say you put $30 in, right, and it moved, and you're losing $15. You can cash out and get your $15, right? But if you let
let me ask you this next question: if you buy those puts, and the price rips up, and you lose that premium, how much premium would you expect to lose? Like, I guess what I'm trying to get at is like if a whole bunch of people started buying puts on a low run down, right, and the market wanted to try and make money, the market wanted to try and off that low hanging fruit, and they ran the price up, how much money went to make off of like a general position? Like how much would those premiums look like, I guess is what I'm trying to get at. You know, because
that all depends on implied volatility and your delta, right, Froggy? What your contract actually cost you?
Yeah, that's part of it. Time is the other part.
So it depends on if you buy a weekly option or a farther out option, right? The farther out you go, the more expensive the option is as well.
Yep.
Because you have better chance of it being in the money. But if you're just strictly talking a weekly option, right, which is kind of what I do. So say you buy a put for $30, you lose $30 if it goes up. But that's with one contract though. I'm just speculating. That's pretty low. It depends on the stock price and a whole bunch of other factors and all that. But I'm just saying in general, if that's what happened. But people don't usually play just one contract, right? People play 2, 3, 4, 5, 6, 10, 12, you know? And
that's what I'm trying to get at is I'm trying to understand how much money could you potentially lose on a put position that never finds itself in the money over a week period of time, or are we talking about, I don't know, is he even talking about those kind of things? I guess maybe we need to continue to watch the video, but I guess when he started talking about up rips that happen fast, I wanted to just kind of mention or throw it out there that these up rips oftentimes happen in the aftermarket hours or in the pre-market, and means that if you have a put position in there, you're going to lose, and you're going to lose it all, more than likely. But anyways, go ahead and keep playing, because maybe he gets into the rest of that.
All right.
But I don't think that the education is quite there for all of retail yet, or for the very least, you know, those who do play calls alongside buy and hold. Remember that we just stated, if you are emotionally very level-headed, if you feel very good about yourself just buying and holding, and you are even keel every single day, this isn't the video for you. The last 3 videos are not the video for you, right? But if we know this and we look at the psychology of it, the super long scale down rips are trying to accomplish 2 things. 1, sell your shares. They want you to sell your shares. That's the ultimate goal of these super long drawn out down rips. 2, to collect premium on calls, right? To collect premium. These come from calls. You can look back. I'm not going to go over the data right now. Go check out the previous 2 videos. Those are still very factual. So knowing this, the grand sort of consensus and analysis that you can come to, the conclusion, right, would be that these up rips are meant to trap premium from calls into these down rips. It's meant to get a lot of retail to start buying calls up again, to get the flow super, super bullish so they can collect it. That's what market makers want to do. They make money by collecting premium. That brings me to my next point, OBV. I want to discuss accumulation and what this sort of means. I'm going to keep this very quick. Accumulation and what this sort of encapsulates. If you look at OBV, you can see that the line continues to go up. To put this in the most simple way possible, what this means is that every single rip up, despite the fact that there have been massive down rips, have been meant to accumulate shares. Despite the fact that AMC went from $72 down to about $12, not only did retail hold on to their shares, but institution also held on to their shares. This is apparent. There's no arguing this because it's factual. It's data. It's math. You can see it here, right? OBV has stayed high. Nobody's selling this shit. Nobody's selling their shares, right? If that's the case, if we want to take these 2 things into consideration, that number 1, shares are being accumulated, right? Shares are accumulated. Number two, that premium is being collected on calls. What can be the grand consensus on what the solution is here, right? If we want to take away the consideration of IV imbalances and that calls are always more expensive than puts, we can do that. If you want to take that away, that's fine. You want to take away the P word, the put word, that's fine. Let's take that away. Let's look at what this means. It means that down rip purposes, the slow algorithm, the deceleration of the algorithm is meant to collect call premium. This is inherently true. This is 1,000,000% true because it shows. We can look back. We can say that those who are not just buying and holding, those who are buying and holding but also playing options are playing calls. And then that premium is being collected. When that premium slows down, you get an up rip, which brings us back into an increase in overall call premium being played, right? What this tells us is that there is an inherent cycle that goes back and forth, back and forth, back and forth by market makers to try to tire out retail while there is accumulation taking place. So what does this mean? What are my thoughts on this, right? If we were to dumb this down and keep this as simple as possible, I've got it into two categories. Buy and holders, do your thing, man. I'm telling you, I am not here in the least bit. You can call me a shill. You can call me late for dinner, but you got to call me Trey. That's very important here. Buy and holders, just do your thing. If you feel emotionally completely level, you don't view green as good, you don't view red as bad, green is happy, red is sad, just hang out. I mean, that's really it. Just do your thing. And in no way, shape, or form am I telling you to do anything. You know, you control what you want to do at the end of the day. You buy, you sell, you play calls, you play puts. I don't care what you do, right? That's ultimately your decision. But for these options players, if for anybody out there, I would actually even expand this just a hair. If you are emotionally imbalanced, if you're in a state of mind that happiness is derived from something that is tangibly uncontrollable, we need to be teaching people education, right? This doesn't even inherently mean puts, right? If you want to take this away, if you want to take away the put piece of it, you want to step aside from the fact that I believe puts would change the balance of IVs, we can do that. At the very least, though, we need to be teaching people how options work and when the right time is to play them, right? And my follow through, right? Me walking the walk is that I am going to make a long formed video tomorrow. It's going to be an options masterclass going over the Greeks, going over the mechanics of options, how they change in price, strategy of options, and things to personally be watching for. But the education needs to happen because there is inherently something that's provable. Not all retail plays options. There are those who simply just buy and hold, right? That is absolute fact. But there are those who do, who are being stolen from in broad daylight. If we can make two general conclusions, which is one, that options make big moves happen. They do, right? Whenever you see big markups, that is inherently because of some form of gamma squeezing or failure to deliver covering, which comes from options, right? That is inherently true. If we can make that conclusion, we can also make the conclusion of when this thing is not happening, that options are inherently being stolen from, are being robbed, right? This means that we've got one factor down, right? We have inherently some form of a way to disrupt market maker sort of algorithms. That is absolutely factual. We have to then find a solution to this problem. I've listed out in the last two videos.
He's not, I mean, again, I got to touch on this, and he's not realizing the full big picture here. It's not just market makers, it's also long institutions, right? Everybody wants to make money off of these writing, buying, and selling of options. So by not recognizing that there's the long thesis on this, where there's those premiums on the other side of the play too, is a failure to recognize half of the system. So he's only focusing on just market makers and hedge funds and leaving out long institutions who play a role in trying to suck up just as much premiums as those other guys. So, I mean, I just got to touch on it again because it kind of bothers. He's not looking at the whole picture and saying, or recognizing the fact that there's more than just market makers and hedge funds, because it's really easy to get into one of those situations where you say they all the time, and when you understand who they really is, it's the entire institutions is they. It's not just hedge funds that are they're not the only ones who are responsible for retail losing money. There's also long institutions. It's also the government. They is also the government. Everybody, they is everybody besides retail.
Pretty much.
So,
it seems like they're hunting us playing this play.
Right.
Agreed.
Absolutely. 100%. But that's what they're supposed to do. That's what they're supposed to, that's the whole design of the market is for them to is to make money. Any business in any business situation is to make money. And when you start to realize that that's what are created and what they're there for them to do, you start to have a different appreciation for why it is what they do and why they do it and how efficient. And my gosh, they are so efficient at gaming the system, extremely efficient, and they've had a lot of time to do it. But I just had to point that out. I'm sorry. Keep it going.
That total an hour and total length, very well thought out sort of premises here, what I think would work. But at the very least, we need to be able to educate people how options work and when the best time to play them is, because the fact of the matter is there are people who do play them that need direction. All right. And my general consensus to that is I'm gonna do my part. I'm gonna give you guys an options masterclass. I'm not giving any bias. I'm just gonna tell you how they work. And from there, you can do whatever you want to do. But this is inherently something that I believe needs to be addressed. It doesn't matter. Like, let me tell you this. This is my final thoughts. This is how I'll close this out for this TLDR. If you do not want to play puts, that is okay. I'm not telling you to. And no, in none of those videos that I tell you to play puts, I've told you what I think makes sense to protect yourself from downside, to sort of level out the emotionality. That's cool. Buying and holding is very important. And if you want to view this in any sort of way, what market makers and sort of composite man, right? The grand scale villain. What these guys want to do is shake and steal from retail. That is the point of these super slow, drawn out bleeds. Steal from retail. That's the point of the slow bleeds, and that's the point of the quick rips. The quick rips, psychologically speaking, get people to want to buy. The slow bleeds get people shaken up and to leave. I mean, you look back to last week, how many big people on Twitter, I saw one guy who said he had 56,000 shares, say all of a sudden, yeah, I'm out, I'm done, I'll come back when the next rip happens. That's the point. That's what they want. This is what they want. This algorithm and the way that it works, we have to find a way to manage human psychology. We genuinely do. Human psychology is 1,000,000% what is at play here. And the solution to that, to me, is education. If you don't want to play the game, if you're a buy and holder, I just recommend you don't watch any YouTube. Don't watch YouTube. Don't engage on Twitter. Just buy your stock and walk away. Set price alerts. Genuinely, don't watch me. Don't watch me. Don't, please. I'm terrible anyways. I'm sure I'm not that fun to watch, right? But if you are actively watching charts every single day, if you're engaging with Twitter every single day, evolution and education is the answer. We need to keep leveling up. And there's, without a shadow of a doubt, people losing and market makers making money on options, collecting premiums, selling calls, because you can just see it. The algorithm tells you the story. Super fast algorithm here, right? Went very slow, marked up very quick because there wasn't that many people in the game. They weren't making that much premium on calls, and they were probably making more on puts. They marked it up, right? This is it. This is it. Please. I'm going to do my part. I'm going to make a very long video, a well thought out video. I'm going to be formulating this for the next probably 24 hours. What makes sense. But at the end of the day, we have to find a way to educate people on options. That's it. I genuinely think that to be the case because that is the human psyche. This is it, right? That's what I've got for this video, my friends. I genuinely give a shit, all right? In the future, if you guys, I held a Discord space, whatever, stage. If you want to talk about this, we can. But that's what I've got for this video. So until the next one, I'll catch y'all later. Appreciate you. Much love, late taps. Peace.
He said a few things I agree with. I think education is important. Number one, people should kind of know what the hell's going on with options, right? Whether you agree or disagree, doesn't matter. That's what this whole thing is about, to discuss that. And I genuinely think that he does care about the community. I'm not sure what he's talking about will work. I think there's a lot of I've already said my piece on it. I'm not going to repeat it, but I just I don't know that it'll work 100% like he thinks, and I just don't want to be the one trapped. Is what I'm going to leave it at that.
Yeah, I'm with you, man. Here's the thing. Like, I'm going to say some very unpopular things right now, and everybody's going to hate me for this. Yeah, everybody's going to hate me for this, but it's the
We're gonna
truth.
censor button.
It is the absolute truth. And I told Froggy, do you remember what I told you and Tony that very first day that I had with you guys afterwards when the show was over? And I told you guys, I said, it was after the whole Lou thing when Lou told everybody to sell on a Monday. Do you remember what it was I told you? And I said
No,
I
I'm not
didn't want to
sure.
talk about it live on air. I said that a mass sell-off of people would cause the price to run up. A mass sell-off of people would literally cause the price to run up because it would cause forced buying on the market. And it would absolutely cause the volume. And what happened on Monday that week when Lou suggested should sell their shares, exactly what I said was going to happen when people started selling their shares. You started seeing the price and volume start skyrocketing because orders were being completed. Authentic orders that were being stacked were absolutely being filled and completed, and price started rising like crazy.
I think that's a big part of our problem.
But now here's the other part. What he's saying or suggesting is that we all go out and buy a bunch of puts so that they drive the price upwards. And I think what he's saying is it would work, but we will lose money doing it. Just the same way as if we were to sell shares, we would lose some of our position to get this thing to start moving.
I think that's what the problem is. I think you're right? Like we're stuck at a stalemate. We want the price to go up, and they don't want to sell at that price, or they don't want to buy back in at that price. Which to me, if you just flip it around, means the same thing, right? We want the price to go one way. They want the price to kind of go the other way. You know, ultimately they know it's going to go our way, and we're at a stalemate. We're not selling. They're not buying, right? So the price really can't move too much. And that's kind of what you're saying right there.
Yeah. And so this is why I come to that whole premise of don't play their game. We don't have to play their game. That's the whole beauty behind buy and hold. We don't have to play. And if we don't play, it's actually better. It's better when we don't play because they're forced to play the game for us and they lose. They lose because why this is the best part. Why do we win when we stop playing the game? It's because there's long institutions that want to win with us. We literally have institutions who want to win as well. And we have big institutions, BlackRock, Vanguard. We have institutions that are on our side and they want to win too. But we don't have to play the game because so long as we play the game, they're going to just play it with us and continue to just keep us stalemate because that's how they make money.
Now, can you explain your concept on how selling would actually make the price go up? Because that doesn't make sense to me. But
yeah,
if you can explain it.
Yeah. So
you're talking to him or me?
No, go ahead. You can answer. I would love to. Go ahead.
Oh, all right. So if people started selling, right, the price is going to go up because they're going to start covering, right? Right now we're at a stalemate. And I'm not telling people to sell, believe me. That's not what I'm saying. But I think that we're at a stalemate. So they want it as cheap as they can get it, right? So I'll give you an example. You want 5,000 or whatever. I want 4,000 or whatever. I'm just speculating right now, but right. So I'm not going to sell my shares for $20. Are you?
No.
All right. So we're at a stalemate. So when people start selling, the price is going to go up. We're kind of at a stalemate. I think that's where we're at. And I'm not telling anybody to sell their shares. I'm just saying the majority of us want a higher price for our shares, right? So even if people did sell at $20, right, it's still not going to make a big effect. So that's my thought process on it.
Yeah.
As far as that goes,
they
does that
need
make
shares.
any sense though?
They need shares, period, right? There's no liquidity in the market, and so it would cause forced buying. As soon as you start selling shares into the market, it causes forced buying. The only way for them to because there's so many shares in existence, what they'll have to do is start borrowing a whole bunch. They would have to absolutely start massively borrowing shares in order to keep the price down. And so what you see is this you see an unhedging of positions that have been created over time when those shares are sold back into the market. But by no means am I suggesting that anybody should sell. In fact, I would never ever in a million years consider that as even close remote option. We're here to win a game that we came to win, and that means buying and holding and not selling. I'm not here to allow them to get away with, anything. I'm not going to let anything happen because I want to win this battle so bad. I've been in this market since 1998, and I've seen 2 market downturns, both in 2001 and 2008. And I'm sick and tired of seeing retail get punished. I'm really tired of it, and I think I'm ready for a change. I'm ready to see us win for once.
I think we pretty much wrapped everything up. One a lot longer than I was expecting. We only covered half the videos, but still, at least we got to cover it pretty good and make a little bit more thought of it. I still like the buying in the money idea. I do think that kind of makes sense, but what you're saying sounds like if you let a couple of the shorts out, they'll quit battling us, and that's pretty much what.
I don't really want anybody to really do anything rash, crazy, but I don't know. I'm just gonna shut up.
I mean, here's the other part too, right? Like if I was correct in my thought process, people would be losing money along the way. So, and the other part to this is for an idea like mine to work in the first place, it would take a bunch of people to decide on an exact amount that they wanted to sell back into the market, and it would be collusion, and we're not playing that game. That's not the game we're here to play. We're here to play the game the correct way, and we're going to win it with the very easiest ways of possible, and it's just through doing what's legal, which is buying and holding. And there's bananas.
Just see your banana, everybody.
This is what Froggy thinks of what I'm saying. You're bananas.
Yeah.
He's like, that's your signal, Casey. Shut up.
It was me. I figured I'd throw it up there to be a wise guy.
But yeah, no. You guys are great, and Froggy, thanks for having me on tonight to talk about this. And I wish Astro or Trey would have shown up, and I'm not holding it against them. They have busy lives and busy schedules, and I wouldn't expect that they would necessarily show up anyways. But this has been recorded, and my hopes is that they saw at least some portion of it or watched some piece of it, so they could see what our position is and where we stand and how we feel, and they could have a rebuttal. They could have a rebuttal to it.
I think what they're trying to get across is like educating people is definitely important at this point, and doing the same old thing. I mean, I think it's still going to work in the long run, but getting people to stop buying way out the money calls is probably important. A lot of people are being really stupid by buying way out there, and they're just getting blown out. So if we could change that, take some of that premium away from the market maker, that will starve them out too.
No, I agree. I mean, I think if we continue on the path we're going, we're winning. We are winning anyways, right? We're winning right now. Why, get everybody up in arms? I don't know. And I don't disagree with what he's saying. Like, if you're an options trader and that's what you're going to do it. You don't have to tell anybody what you're doing, right? Keep it to yourself, whether we agree with it or don't agree with it, right? But I don't know. I don't think that the information they put out is wrong or bad. It's just, there's a lot of people in this trade who don't understand. I'll just leave it at that.
Yeah, and the whole point of this was it had nothing to do with bashing Trey or Astro. It had everything to do with trying to figure out what works, whether this made any sense or not. Like, what did it actually mean? And it seems like we did kind of get to the bottom of it. So, I mean, we got a clear perspective of it, and that's important. And I still think training is, like, education is definitely important. So,
truth and knowledge.
Yep. So, do you guys want to close things up?
Sure. We want to go first.
You guys can bypass me, and I'll just say thanks for having me on, and I enjoy talking with you guys always, you guys, and you know, and mediocre. If your microphone wants to go out, I'll get it out for you.
I might. I'm gonna be honest with you. I'm actually I took that video and I'm working on it now. I'm gonna put it on my channel. That's funny as hell. I love it. But I want to say good night to everybody. Thank you for coming. Again, no hard feelings with Trey or Astro. I think they're good guys and they do a lot of research, and there was no disrespect to them at all. But I think we should be talking about it. But thank you all. Froggy, thanks for having me as usual. And Casey, good to see you, buddy. Don't forget to beat that like button and that subscribe button and hop on over to Froggy's channel and do the same. And same with Casey.
Thank you.
Yeah, thank you guys for coming. Definitely hit that like button. That's important. But other than that, we're out. Thank you guys for coming, and peace.
Take care all.